Greetings, traders. It is I, Abdul Shabazz, and this is some real change stock options trading journey. And today, this magnificent Monday, August the 17th, I want to thank you guys for tuning in and being a part of this journey. Big shout out to those of you who are joining us on kicking us with us as we just talk about money. Let's go ahead and talk about money, where it's at, and how to acquire some. Through taking advantage of the market presenting wonderful opportunities to us and taking full advantage of those opportunities if and when they do present themselves. Pretty much going to open up right where we closed Friday. That's what we're looking like for the most part. I'm not interested until anything gets below that 775 area. Go ahead and put an alarm there right out the gate. Not interested until we get below that. I'll go ahead and start with this view. It's going to be a good view. Top right is the daily chart. Bottom right is the weekly chart. Bottom middle is a 30-minute chart. To the left is the 15-minute. Above that is the 2-minute chart. You can already see that I've identified a controlled selling algo coming into market open. Nonetheless, it is still appearing to be open in the same area as Friday's closed, which is why, excuse me for a second, Bismillah. Alhamdulillah. You can see that's why I'm not interested until we get below the 775. I do want to move this alarm up a little bit. Okay, so that's what I'm interested. Also, I'm not interested in buying a new high because we have put in a lower high at the 778 pre-market. We've gone from that 778.8 area. Let's talk about it. 779.3. Thursday's high, and then after that we put in a lower high Friday, and coming into the market right now we're putting in an even lower high as far as the pre-market trading is concerned. So I don't have any areas that interest me for a call. I don't have any areas right now that interest me for a call, so I'm not interested in a call whatsoever coming into market open. In fact, I'm going to set my alarm, allow the charts to do what it does, and if I see an opportunity present itself, looking at the higher time frame, then I may entertain something. But as for now, I don't have any plans for a call. I'm only interested in a put if we get below the 775 area. So I do have that. As for now, I'm looking for that 775 area for the put. Believe we can take it down to 773. For the market, find some support there. Let's get to the bag. Aubrey Myers is in the building. Let's get to the bag. Tell me what you think, teammate. What's on your mind? What's your game plan? For me, I don't have any ideas or any plans for a call right now this morning. And I'm only interested in a put if we can get below 775. As of right now, I have identified a controlled selling algo coming into market open. You can see it right here in the middle screen, top middle screen on the 5-minute chart. Right there. That's where we're at right now. But as you know, we only use our 5-minute chart for entry. We don't use it for making a decision. We do use it for guidance. It's early. It's Monday. Let's give the market some time. We're opening up in the same area of Friday's close. As you can see, top right chart is the daily chart. You can see the area of Friday's close. So if the market hasn't made a decision yet, neither should you. Let's continue to be patient. It is our patience that pays us. Looking at my trading view chart right now, you can clearly see that we are and do have some sideways action right now. Nothing too exciting right now as we trade at the 775.9 area. We have identified that controlled selling algo, but I'm not interested, as I said, in a put until or unless we can get, let me show you right here, diagram for it. I'm talking this area right here. I can see something like that. You know, that is what I like to see. Not really interested in a call, because as I told you, after we made all-time high, we put in a lower high, and then even now is another lower high yet still. So I'm not interested in a call, only interested in a put if we can continue this downward trend and put these bulls right here, get them a little excited. These guys right here. This is who has my money. If I take a call, if I take a put, this is who I'm attacking. This is who has my money. If I can get these guys in trouble, there might be a nice little opportunity there. Until then, I'm staying safe and out the way. Again, not interested until we get below that 775. I'm not going to do an ad. I'm just take it straight to 773 if it happens, and be content with those profits. All righty. Dr. J's in the building. Shout out to Dr. J. Go check out resetwithdrj.com. If you want to learn how to lose weight by resetting your metabolism the healthy way, the correct way. No diets, no gimmick. Just getting your body back to operating the way it was always meant to be. Check that out. resetwithdrj.com. Spelled just like it sounds. Reset Dr. J. Just the letter J. Thank you so much for sponsoring today's show. Yep. Guys, it's pretty much going to be it for me this morning. I'm going to go ahead and let the experts talk. I know what I want to see. I'm going to wait and see if we see it.
There's a lot of negative stuff out there. But when you get that weaker stuff, yes, we should have had interest rates down. So it was a combination of weaker data and interest rates go up, and that is awful. Okay, yeah. Let's not even mince words. That is awful. Like I felt on Friday, and I was trying to make the sauce, The wife said, the wife, that sounds great. The wife. I'm going to take
So I says, though, I says, hey, where's the sauce?
No, it's holy hell. But that one I want to take back instantly because the phone lines have lit up because your husband's such a jerk. But she wanted the sauce, and I went to look at the market, and I couldn't believe how bad it was. And Jeff Marks was saying in the afternoon, wow, it really broke down. And yet we somehow felt like, so what, it's fine. That was a nasty breakdown. Yeah. And it took down a lot of really good stocks, and I don't think you can ignore that.
I'll tell you what did impress, I guess, on a relative basis, Jim, on Friday was Disney, which got to 106. That's been that first couple peaks above the 200-day in several months. Julia did talk to Josh tomorrow at D23. Take a listen.
I'm not happy with where the stock stands right now. Our investors aren't happy with that, but I do believe that we're sitting in a very great space relative to the entertainment industry. As I said a moment ago, if we just continue to execute on what we've committed to, streaming growth, top line and margins, continuing to push the envelope on the experiences business, make the conversion to direct to consumer on ESPN, and just make great films, which make that flywheel spin. If we keep doing that, I think we're going to see the returns come back to us.
We'll see. I mean, we've talked a lot about the strength of the box office all year long.
I've been a big believer in Josh. First, congratulations to Chris Berman, ESPN legend, now at Disney legend.
Nice. Along with Lynn and The Rock and everybody else.
Yeah, I think it matters, and it matters. It's a good example of what they have this ESPN. And it's been somehow an albatross. I think that's ridiculous. They have all this great film and they do great things. Now Josh ran the cruise ships, and if they could double the cruise ships, then the numbers would go up big. James Gorman put them in a terrific situation during this interim. Do I want to own Disney? We owned it. It's very hard to own that stock because it's kept down by the cohort. The cohort is so miserable that you keep thinking, I don't want to get ahead of myself here because, oh man, everybody else is doing terribly.
Yeah. Your point about cruises, though, I know you've always liked Viking. They report this week. That's a 40% gainer on the year.
Well, Viking is no gambling and no kids.
Yeah, no kids, right?
No kids.
Right.
I mean, that's a dystopian place. Huh? No kids.
In banks, Jim, there's some chatter. You mentioned the FT piece on private credit concerns and the value of troubled loans getting close to the levels we last saw in 17. But the other piece is about regulation, especially in the UK, and how this sort of deregulatory wave we saw here has moved over to the other side of the Atlantic.
I mean, look, I think that there's a sense that the banks were hobbled and people were going to non-banks, and the banks are actually really well regulated. People should be in there. I spent a lot of time with people in the banking industry, in part because I think I'm ground zero when I'm out there in the Hamptons. Kind of F. Scott Fitzgerald meets J.P.
green
Morgan
light and everything.
But I do think that J.P. Morgan, I'm going to say it, I think it's still radically undervalued.
Really?
Yeah, I put it down as stocks I wish I owned, J.P. Morgan. 15 multiple, just doing everything right. What is it doing down there? Why?
Yes.
I mean,
does your rule about it's okay to buy at the highs, does that apply to other sectors beyond tech?
I think when you have J.P. Morgan up 12% in a year where J.P. Morgan could be the dominant banking institution worldwide, that makes no sense to me. I mean, what are people thinking when they sell it? Because it's 14 times earnings. They expect it to be at 13 times earnings. By the way, I am a believer in Wells Fargo. Charlie Scharf, one of the sharpest minds in the business, that's down 4% for the year. You want a bargain? 12 times earnings. 12 times earnings. I mean, when Buffett loved it, it was never this. Well, it was 10 times earnings in 1990.
We haven't done much of the 13 Fs, but you mentioned Buffett. Alphabet is now their third largest investment.
Yeah, that's gutsy. I mean, I think that a lot of people hanging their hat on that because they do so much good work. But of the Magnificent Seven, that's the one that I think is still kind of vulnerable. After Microsoft did that tour de force conference call, the Microsoft, by the way, Microsoft conference call was maybe the best conference call this quarter because it turned a huge cohort of people in favor of it versus against it. We didn't see that with Google, and we're still waiting for it with Meta. I still believe that if Mark Zuckerberg wanted to, he could take that stock off the near 52-week low, all right, 580 to 520, and turn it around. But he has to say, you know what, I've really thought about this, and we're going to rent out because we have so much demand. And then he'll name like 3 companies that need some of their cloud business. But I wish they could finish that thing in Louisiana. That's a long-term business.
I mean, we've talked a long time. Give us a longer duration chart, but it has been a series of. I mean, the highs haven't gotten more impressive over time.
No, I mean, this is an example of like, you'd rather be in a good tool and die company. I mean, honestly, you could go into Cummins, which didn't have a particularly good quarter, and you can still get a better performance.
Well, you know what's once again the #1 Dow name of the year?
Caterpillar.
Yeah, Caterpillar.
Well,
having displaced Cisco the other day.
When I look back over, I went over Caterpillar's conference call again, and it is amazing how much of it is engines for data centers. And a lot of that is gigantic projects where you can get 1,000 engines and you hook them up to natural gas, and suddenly you got a gigawatt. And a gigawatt is like nothing to sneeze at.
Big deal.
400,000 homes. And by the way, Joe Creed, he's very low-key, as Jim Umpleby was, Joe Creed, the CEO of CAT. These guys are the least pound-the-chest executives I can ever recall. They're remarkable in their decision to not promote themselves and the company, which kept expectations low, which is why it can continue to go higher, up 50%, and I think that's still a buy.
Interesting. The leaders this morning are so thematically pure. Western Dig, SanDisk, Marvell, Micron, and then Coherent right behind it.
Right. Now, that's why I like Corning, because the Coherent's a very nice analog. Matt Murphy at Marvell correctly moved into optics just when he should. People continue to underestimate Matt Murphy. He's one of the titans in this group. He has done so many things right. It's that you say underestimate. It's up 177%. There's more to go there. Matt Murphy's got more to go. That's one I would buy right now.
Yeah. All of that kind of ties into the 2 AI labs that are obviously so important for the future of the build-out. Brockman on Squawk today covered a lot of ground. Take a listen.
Fundamentally, the way that the organization, like, we're a very resilient organization. We've been through, if you look over the years, that there have been different eras where we have different sets of leaders in place. I'm a constant, Sam is a constant, and that I think that we are stronger because of that resilience and diversity. I actually think that the difference between OpenAI and other organizations is that we are so much in the spotlight, so every departure gets scrutinized in a way that it doesn't otherwise. I actually don't think that it's actually that atypical, kind of how we operate and the longevity of people.
He's referring to the chief revenue officer who left last week after less than a year.
I think that we have to accept the fact that there are people. There's a good piece today about how many billionaires there are. I think you have to accept the fact that everybody's poachable. There are no real. I mean, this is not the NFL where people have to, like, there's a 4-year and you can just get rid of them after 3. Someone's taking them. I was going back and forth with Sarah Fryer today, CFO of AI, just talking about how, look, you got to really focus on this cyber issue, that I've not done enough, that everybody has to do more. It is a danger. I believe that if we had let NVIDIA be in charge of China, meaning people wrote on China. That was one of the worst decisions the administration made, because it empowered all these Chinese companies to do all these models. And it's disturbing to me. Obviously, I don't think it's great. But on the people who are leaving, like, if there's nothing seems to be binding. And you can why not become a billionaire if you have the opportunity because you went to a good school and you know what you're doing?
Yeah, I mean, look at Google and some of the deep mind losses they've had there.
Yeah,
but your point about Jensen, who's argued for a long time that being a security hawk on China tech is I think he called it a badge of shame. You think that's essentially correct?
Yeah, look, I just think that we could have, with the exception of the PLA, which would never let us write on anything that's ours, we could have made us the gold standard in China, and that would have been so much better. And everyone, like I got some pushback from people in the administration who said, listen, you don't know what you're talking about, which is always code for you know what you're talking about. And it really completely bothered me that you had this situation where Jensen had totally gamed it. Hey, by the way, name me someone who left NVIDIA.
That would be hard to do.
You know, I was with someone who was in NVIDIA recently, and it's very difficult. Like, you go, I mean, here's NVIDIA. Like, okay, I know we have no camera. It's ridiculous. But we should have handheld, but I guess that's too expensive. We can't because we're trying to get through 42. But it's like, hey, Bob, how you doing, John? Hey, sure, Steve, you want a selfie? Oh, Elizabeth, you're great. And, like, they don't even know his name before he knows, and there's like 30,000 people who knows everybody's name.
Yes.
And they're not leaving. Why would you leave if you're like, you know,
everyone wants to be nice to you?
Yeah, I mean, like, hold on, I want a selfie with you, but I'm taking off and I'm going to Western Digital. No! No, I mean, people have to understand the loyalty to Jensen is incredible, and it's why he's loved. And he's a first-name guy. I mean, I was with someone this week, he said, you know, I was with Jensen. I said, well, I was with Jensen.
No, I mean, we fall into that trap here. I mean, we probably shouldn't, but we do. We just refer to him as Jensen.
Well, you know what? I was with someone who was talking about Chuck. And with Chuck Robinson.
Yeah.
So, I mean, we ought to have a list of first. We should put it up.
No, it's like Madonna.
Who's Cher?
Yes.
Who's Cher? Let's get Cher up there.
Yeah.
But I do think that there's not a lot of departures from NVIDIA because people love working there. And that's often indicative. Now, does that mean OpenAI that they don't like working there? No, it's just they're easy to poach.
Yeah, I mean, they definitely have the moat hanging on to 225 this morning. As we go to break, watch bonds. You'll see some chatter today about the national debt, which is poised to cross the $40 trillion mark for the first time sometime, I think today, if not already.
We're going to grow out of it.
Yeah, we'll grow out of it. 528 on the long bond. Stay with us. We mentioned some of the laggards in SAS today after that downgrade, actually 2 downgrades of Workday this morning. The other interesting one is McDonald's. Nice journal piece about QSR and how Burger King basically revamped the Whopper. And as we know, Burger King comps are running now at multiples
Yeah,
of
I would have
McDonald's.
given Patrick Doyle more executive chair. I think he had a little bit more to do with it. I think.
Yeah. Interesting turnaround in the restaurant business. Dow's down 116. Stop Trading with Jim is next. Time for Jim and Stop Trading.
One of the more irritating parts of this market is the insistence of loving fintech. The analysts just love fintech. And the three that they love are SoFi, Klarna, and now PayPal. Look, I totally understand it, but you don't need to reiterate every day, people. We understand PayPal may be a takeover candidate. Klarna is really doing great. SoFi, it's going to come back. Just stop. Analysts, stop recommending these. Let them go to where they are on the downside, and then you can recommend them. But this endless, let's keep the ball in the air, it's a volleyball thing, except you really only can touch it 3 times. I really think that what's happened is that PayPal, when we heard that they might get a takeover bid, it made everything really exciting to people.
Right.
But I just think no, just go buy Wells Fargo and go buy JP Morgan over Klarna, okay, or over PayPal.
So you feel the same way about Workday and SAS?
I think that Workday, that was a good run. How about that? That was a very good run. And I noticed that Salesforce already started coming down. We do have a Salesforce conference coming up, and I know Mark Benioff is going to say that everyone's just dead wrong. Can everyone be dead wrong? Conceivably, but what I don't like is these, and I didn't put a firm in this group, and the reason I didn't put a firm in this group because that one should be at 100. That one is real. That one has the growth that I want. That one has the CEO that I like. That one has short sellers and people who don't really understand that Levchin he's brilliant. Max is brilliant. And I just think that one is the only one that I would buy right here.
Yeah. Well, if we get more indications of a softening consumer, you might see some attention on a firm.
Well,
in a positive way.
Buy now, pay later. Just does very, very well in this situation. Levchin is a fascinating guy, and sorry, he's a big Ukrainian supporter. I didn't want to I usually don't talk about this stuff, but he's a remarkable man. When he comes on TV, he's a little robotic, but I want to invest with a robot over a person.
Jim, busy week ahead.
When we're ready.
Yeah, let's do it. We'll see you tonight. Mad Money, 6 p.m. Eastern Time. We'll come back. Dow down about 190. Stay with us.
Team. Let's go NVIDIA. James, what's up? What's up, fam? How you doing? New Kirk in the building. I'm late. Good morning, team. Jesse Swanson. Yes, sir. Dolph in the building. Yes, sir. What it do, Dolph? Yeah, letting the market get settled right now. Looking at this controlled selling algo. The whole market is red right now except NVIDIA. NVIDIA is holding the market up right now. Being patient. And the 10 o'clock candle getting ready to drop on us in another 40 seconds. So, again, looking at the larger time frame. Looking at the larger time frame. I'm here, I'm just in the background, letting the market do what it does. I'm gonna go ahead and adjust the algo to show this controlled selling that we currently have right now. But again, being patient. 10 o'clock candle is coming upon us. Top right, daily chart. Bottom right is the weekly chart. Bottom middle is the 30-minute. To the left is the 15-minute. Top left is the 2. Top middle is the 5-minute chart. I have an alarm at 7:75. I'm not interested unless we get a break and retest.
Good Monday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Leslie Picker and Mike Santoli live at Post 9 of the New York Stock Exchange. Sarah Eisen and David Faber are off. Stocks mixed on this Monday as the S&P comes off 3 weeks of gains. We're going to talk to an expert who says the rally has a lot more room to run. Might push the S&P past 9K. Berkshire upping its stake in Alphabet in a big way in Q2. Now its third largest position. We're going to take a look at that decision. And the CEO of Brown Harris Stevens will tell us why she says the pied-à-terre tax in New York City already having a chilling effect on its real estate market.
And speaking of real estate, home builder sentiment just crossing the tape. Rick Santelli has that for us. Good morning, Rick.
Good morning indeed. This is the August read on the National Association of Home Builders Housing Market Index, expecting a read under 34. It comes in stronger than expected at 35. Now, the low reads of the year thus far are 34 on several different occasions, so this is just a smidge better, and the comp goes back to, well, just June when we were at 36. But there's something interesting about this number. This is the 16th consecutive month that the reading has come in under 40. That hasn't happened since the aftermath of the credit crisis in 2012. So we want to pay particularly close attention to this variable. And the reason it's so depressed is, well, mortgage rates are high, affordability is a huge issue, and the K-shaped economy. We have the lower income still preferring the multi-dwelling, which has been a bit stronger in things like starts. But we see high-end homes and high earners seem to be paying cash and moving that high-end market a bit. But in total, still a depressed figure, as I said, 16th month under 40. Mike, back to you.
Rick, thanks so much. We were going to dig in a little more to this, the market here, and kind of the setup for the week. I think you have to say we got 12 days in which the S&P went up 6%, feeding off of a bunch of different channels of relief. Obviously, we stopped punishing the big AI spenders. Semis pullback turned into a pretty good rebound because that disorderly selling ended. And then, reduced Fed rate hike expectations. I think now we're at the point where does relief transition into belief that this is sustainable? In particular, the earnings bonanza that we've seen. People are celebrating it. I understand it feels really virtuous when we see the stock market go up and earnings go up more. It feels like the fundamentals are in charge. I do think that we have to struggle, though, with some of the elements of this earnings growth, whether it's a pull forward of longer-term AI demand that really reflects continued capital raising commitments down the road. Of course, the Wall Street Journal with a lot on that. You got some fragile charts, too, in some of the recent beneficiaries like Google, Meta, things like that. They're just sort of perhaps not yet ready to start to take the charge and lead. And then, you have this time of year where we have room to risk further, I think.
And I just wanted to interrupt for a quick moment. But you see, right where my alarm was, it hit my alarm and then bounced right back from there. Because below that 775, okay, the bulls now begin to get in an uncomfortable position. That's why I'm not even thinking about a put until we get a break and a retest below that area. I'll put the alarm there for a reason, so that way I don't have to constantly be looking at the charts. It's strictly business with me. Anything above that 775, I'm not touching. I'm not interested in a call because we already have two established lower highs. If we get below that 775, I'm not even jumping then for a put. I want to see a break and a retest. It's Monday, and the market builds liquidity on Monday. Every day is not a trading day, and that's why we've had the success rate that we've had this month so far, is because we make sure that every trade that we take is worth it. Thank you for your patience.
Could be. But do you think that the market is currently pricing in that these peak levels are pricing in that things could decline from here?
It's pricing in perhaps that it's the peak of earnings growth rates, and then next year, it's obviously going to step down from there. But I think we're kind of scrutinizing the composition of the earnings as well, and people keep talking about that. Not so much that it's not real. It's just obviously a lot of the AI spend is a pull forward. And then we all talk about the markups on the private investments. And we also were anniversarying the Liberation Day quarter last year. So for a lot of non-tech companies, there was a little bit of a tailwind just getting past that. So, I know it sounds like unfair to say, oh, earnings are too good. That's why the market might struggle here.
No, the investment income is real. Yeah. The tariff refunds are real. There's a great piece on the tape today about Union Pacific.
Again, we're referring to the larger time frames. Okay? We opened up at Friday's close area. So far, we are red for the day. But this is a Monday, and it is early. The market is looking red. Everything is bleeding off right now as far as the Magnificent Seven, except NVIDIA. NVIDIA is hanging on by 40 cents. But that's all it takes. But nonetheless, we still don't have anything clear. Any decisive decision has not been made, so we should not even be trading right now. No one should be trading right now, as the market has not even made up its mind on what it wants to do. Looking at the larger time frame with the 30-minute, the 15-minute, the hourly, and even right now the daily. Today and today only, the daily and the weekly are going to be the same. that candle is going to be the same today and today only. Again, now I'm more keen after 10 o'clock to start looking at the quarter marks. 10:15, 10:30, 10:45. Not looking at any action in between that time. I want to look at the volume. Also want to look at key areas on the chart and key times. Other than that, I'm sitting on hands, allowing the market to do what it does on Monday, and that is build liquidity. No one's in trouble right now, so we have no clear reason to be in the market right now.
It had a 10% correction, a rebound, and then we kind of almost hit a 20%. Now, there's a lot else going on. I guess the point is, you have to kind of acknowledge the fringe probabilities as well.
Well, and then if you look at the setup right now, and to be sure, we think that September seasonality is probably going to rear its unpleasant head, which, of course, as we know, almost always creates an October buying opportunity, but you got to get there first, is that this whole idea that 2018, and then you look at 2022, the last two midterms, and certainly in this unique political cycle, have been volatile events. They've been buyable, but you had to ride through the volatility.
Are you getting a lot of questions about what credit markets are seeing that equity markets might not?
So credit is very interesting this cycle because usually, and this just points to the incredibly different nature of this post-pandemic world and the AI world that we're in, is that high yield tends to be the canary in the coal mine, okay? And basically, high yield spreads are near their tights simply because it's sort of a forgotten part of the financing market. And investment grade, obviously tech, where all the demands are the areas that have widened. And from our point of view, what's tricky here, and is again, you saw the 30-year yield hit a new cycle high once again this morning, is that you have the potential for this negative feedback loop where higher yields on the long end make it more difficult for the hyperscalers to do the borrowing that we think they're going to need to do to support what we estimate to be $1.3 trillion in CapEx next year.
Or the flip side, makes it more difficult for the Treasury to do the borrowing.
We can't argue with that.
Yeah.
We cannot argue with that.
There's also a lot more issuance at the bottom rung of the investment grade market too, so potentially paying attention to those widening spreads could make sense in terms of the health of the economy in a way that maybe we haven't historically as we've looked at junk bonds, for example.
It's a completely different environment. We've never had this incredible preponderance of investment grade issuance at a time where the economy is, going pretty well, and at a time where market multiples, to your point earlier, are actually no longer a worry.
Yeah.
That's one of the extreme positives of essentially the July risk-off episode.
Do you want to talk about that kind of extreme right-tail positive potential outcome where you say, look, we could just get a stampede that gets the S&P to 9,000. How does that come about?
So we actually think that if you look at all structural tech-driven bull markets of the last 25 or 30 years, they invariably end with a stampede. Yep. You saw it at the end of 2021. You certainly saw it in Y2K. And from our point of view, and we were having this conversation in Evercore's morning meeting, there really isn't any FOMO out there. There is a sense of unease. Now, investors are reasonably grossed up once again in the wake of the situational awareness unwind. But in our mind, the cycle has further to go, and you're likely to get this sort of euphoric lift as you did previously, which is also why, in our mind, with a VIX at 15, if you want to think into 2027, long-term call options on the triple Qs make a lot of sense as well.
Upside exposure is also cheap when the VIX is
correct.
Yeah,
correct.
It would be, I guess, odd historically if you had this many trillions running into what people are saying is a generational technological shift and not have things kind of get bubbly. right? I mean, whether we did in moments in the past couple of years or not, it would sort of make sense that we get there.
Well, and that was kind of the conversations we were having back in July as people that were tilted towards the memory stocks were trying to figure out what their risk was. And we were making the point that in the big picture, when you look at cycles and you look at the length of the cycle, that alone argues that there's further to go. But think about the valuations of those names at the top of the cycle and the valuations where they go. It's nothing like what Y2K was like.
Yeah, probably won't be like it in detail, I guess, if we get it again. But fascinated to watch. Julian, thanks.
Thank you.
Thank you. Let's turn now to the latest in Iran as the 60-day ceasefire expires today. President Trump threatening to bomb Oman if it gets in the way of negotiations. Eamon Javers is in D.C. with more. Eamon.
Yeah, good morning, Leslie. President Trump on Fox News this morning threatened to bomb the S out of Oman if that country gets in the way of U.S. efforts to reopen the Strait of Hormuz. Now, Omani negotiators have been in conversations with Iran about a new regulatory regime for that crucial strait, an agreement that reportedly could include fees or tolls for international shipping to cross the waterway. Now, in response to the president's comments this morning, a senior Middle Eastern diplomat with direct knowledge of the talks told MS Now's Ian Sherwood this morning that Oman is focused on working towards a solution that leads to the reopening of the Strait of Hormuz. It's their primary objective. But note, that comment doesn't really respond to the president's threat or indicate if the Omanis are likely to back off this emerging agreement with Iran. Now, all this coming as the United States and Iran officially hit the end of that 60-day period originally set up for peace negotiations. Those are talks that have not happened in a peace effort that both sides have acknowledged as having failed. Meanwhile, former Congresswoman Marjorie Taylor Greene taking to social media today with an incendiary claim saying without evidence that the White House is, quote, discussing using nuclear weapons on Iran in strategy meetings. Now, White House officials have not responded to requests for comment on that claim. Guys, back over to you.
Although, Eamon, it does bring up a discussion of asset deployment. For a while there, we were paying attention to munitions, stockpiles, and production. Now we've pulled our last aircraft carrier out of Asia to support these other aircraft carriers that have, as we said last hour, been at sea for so long.
Right. I mean, the question is in terms of how much of a suck the Iran war is on global U.S. military supplies and reserves as you see that repositioning from Asia into the Persian Gulf. And some reporting from the New York Times over the weekend that some of the struggles of the sailors on board that aircraft carrier in the Persian Gulf are the result of Iranian efforts to bomb U.S. supply depots in the region. Therefore making it really difficult for the U.S. Navy to resupply and even feed sailors on those aircraft carriers. Now we're seeing a repositioning of aircraft carriers, hopefully some new supplies for those sailors as they've been deployed for a long period of time. And just real questions about how long the United States can keep this up. You know, if we're watching that, Carl, the Iranians are certainly watching that and keeping an eye on what they think the U.S. supply chain is capable of. And of course, the Russians and the Chinese also watching those supply chains very carefully as well.
Yeah, and whether even the Gulf states are willing to continue to host our troops in the future, which the Journal obviously wrote about over the weekend too.
Yeah,
a lot of moving pieces and butterfly effects. Eamon, thanks. Eamon Javers. Get a look at our roadmap for the rest of the hour. When we come back, it's shaping up to be a big week for crypto. White House reportedly getting ready to host a meeting of executives on Wednesday. Matt Hogan from Bitwise will be with us to discuss.
Plus, Berkshire Hathaway betting billions more on Alphabet, making the company its third largest holding. We'll talk about what drove that decision.
And we'll talk to the CEO of Brown Harris Stevens about this morning's home builder sentiment data and why she says New York's pied-à-terre tax is already having a chilling effect on the market. Let's walk on the streets back after this break.
Big Ben in the building. Good morning, teammate. Yes, sir. Just being patient right now. I'm going to show you my trading view chart real quick. This is what I'm looking like on the trading view. Okay, on my little diagram. Okay. In the building. Good morning. Not messing with anything until we get a break and retest. At the 775 area. Starting to get a little bit closer there. A little bit. But again, I've circled who would be in trouble. The bulls. That will be guarding all the way from the 773. So it might be a nice little put down at 773. That's all you might get this morning with that. And that's what I called out here on my plan. I'm going to take a 776 put, get in at 775. I'm going to get out at 773.4. Simple. Straight shot. If it presents itself. Again, looking at the larger time frame for confirmation. And the larger time frame is telling me we have indices that it's a bearish day, but it's still heavily indecisive. Even though we're in a controlled selling algo right now. This could very well be used as liquidities for the bulls and shoot right back up.
Welcome back. The president reportedly expected to attend a meeting with several top crypto executives of the White House this week. The meeting comes as that Clarity Act does remain stuck in the Senate, with the odds of the sweeping crypto regulation passing this year beginning to dwindle. Let's bring in Matt Hogan, Chief Investment Officer at Bitwise Asset Management, talk about some of the moving pieces in crypto. Matt, good morning. Good to have you.
Thanks for having me, Carl. It's great to be here.
Do we know much about what they're going to talk about Wednesday?
You know, we haven't seen a formal agenda, but we can look at the attendee list and make some inferences. When I look at who's attending, it's a lot from the crypto exchange side. It's a lot from the traditional exchange side, folks like the CME, ICE, the DTCC. I think topic number one is actually going to be tokenization. As you know, there's this huge change in how we trade everything. We're going from 9:30 to 4 to 24/7. We're going from calendar futures to perpetual futures. I think we're going to talk about this mega trend of tokenization and making sure we have the rules in place for investors to do well and for America to lead on innovation.
Yeah, we had Tom Farley of Bullish on the show late last week, and that did seem to be the tone of the discussion. Is that okay? It's going to be what it's going to be, and let's move on to maybe some other practical use cases. What do you think it means for, let's just say, the raw Bitcoin price? Anything?
Look, I think broadly it's positive for Bitcoin specifically. Bitcoin is the largest asset in crypto, and it generally benefits when the administration is focused on making crypto a hospitable place. And I think having this meeting with leaders, with the president there, is an indication of a continued commitment to crypto. So that is good for Bitcoin. The bigger winners from this, or the key winners, I think are actually the DeFi apps. Things like Uniswap, Aave, maybe Hyperliquid, even oracles like Chainlink. The reason for that is those apps are priced today like they're serving the crypto market, which is a $2 trillion market. This kind of meeting says those apps are actually going to serve the equity market, that's a $150 trillion market, or the bond market, that's a $200 trillion market. So I think investors are going to have to upsize their total addressable market for those things. In ETF land, that means things like the Bitwise Hyperliquid ETF, maybe the Bitwise Solana ETF, since a lot of tokenized stocks trade on Solana. I think those are the kind of winners we're going to see.
Is there a motivation on both sides to get the Clarity Act over the finish line before the midterm elections?
I think absolutely crypto wants the Clarity Act to go through. It would be better to build on a foundation of law than a foundation of regulations coming out of the SEC. I don't know that there's a clear path. Polymarket has the odds at about 20%. I think if the Clarity Act does surprise us and pass, we're in a new major market in crypto. If it doesn't, you're going to see the SEC and the CFTC continue to push us forward. I still think the outlook for the end of the year is good, but it's probably a more gradual path because there will be concerns that future regulatory advances could be reversed in a future administration.
Matt, what you said about the actual market not just being crypto trading, but perhaps all financial asset trading, the example of Hyperliquid. I mean, to me, it's instructive for people who have come up speculating in coins and even investing in them on a long-term basis, because the reason Hyperliquid is a thing is because you can trade stuff that's tradable elsewhere round the clock in a different form. It's a regulatory workaround. And so it's just sort of a means to trade the stuff that already exists that people actually want to own, as opposed to it being a new asset class or something else that that somehow is going to really change things, except on a back office level.
Well, I think that's to a degree true. I still think things like Bitcoin are very real assets. These are very real applications. But what you're saying is absolutely right. Sort of Hyperliquid proved itself in the $2 trillion crypto market, but you look today and about half their volume is in what we're calling real world assets. It's the only place in the world you can trade oil on a Saturday. People are using it to trade gold, to trade silver, to trade stocks increasingly. So I do think a lot of crypto is becoming infrastructure, and it's going to trade like that. It's now competing with NASDAQ, right? We used to think of it as a sort of a form of money. There's still aspects of that with Bitcoin, but there is a lot of this exciting tokenization infrastructure. And again, I think people are sort of misscaling that market by a significant margin, because it is addressing how we trade everything in the world.
As for the legislative sausage making around Clarity, a lot of the chatter late last week was about a couple of senators, Loomis and Moreno, who, having seen that legislation get stalled, backed the Credit Card Competition Act, which would have other ramifications for issuers and unaffiliated payment networks, right?
Yeah, I mean, it's also frustrating. Washington is always frustrating. At the core of the Clarity Act is a regulation that will protect investors and that will make us more competitive in this new world of tokenized markets. We should just pass this thing. It's frustrating to see people, pull out little bits and pieces and miss the big story. We are seeing people try to push forward new versions. We're seeing the SEC push things forward. I hope we get the Clarity Act done. But again, even if we don't, we're going to see progress on the regulatory side. I think tokenization is a done deal. We're all going to be trading tokenized stocks sometime in the next 3 to 5 years. That's going to continue regardless. The Clarity Act would just sort of give us a more concrete foundation to build on.
Right. No, it's going to be a crazy 3 to 5 years, no matter what, Matt. Appreciate it. We'll see what happens. Thanks for the time. Matt Hogan over at Bitwise today.
All right, up next, new filings show Berkshire boosting its exposure to Alphabet. We'll look at what's becoming one of Greg Abel's big new bets. Plus, we'll tell you who just spent a record $40 million to buy Ferrari's first electric vehicle at auction. And we'll get to the big moves this morning in the chips, including a pop from Micron and Applied Materials. We'll be right back.
Welcome back. We are about 30 minutes into the hour. Here are three big movers we're watching this morning. First up, Astera Labs higher on an upgrade from Northland, which takes the stock to outperform here. The price target also hiked to $350 from $225, representing about 9% upside. Analysts bullish on what they call a, quote, longer than expected AI infrastructure spending cycle and positive earnings revisions. That stock up about 3.3% right now. Then L. Harris falling after the company announced its CEO was stepping down after a code of conduct violation. The company did reaffirm full year guidance, but that stock down more than 3% right now. And we're watching shares of Alphabet, Berkshire Hathaway bolstering its stake in Google's parent company during the second quarter. According to the firm's 13F filing, which shows positions as of the end of June, Berkshire Hathaway had purchased $7 billion of Alphabet during Q2, and that is in addition to the $10 billion the firm invested in a private placement as part of Alphabet's upsized $85 billion equity capital raise in early June. The firm now holds about $37 billion in Alphabet, its third largest holding behind only American Express and Apple. Berkshire Hathaway is now one of Alphabet's top 10 investors as well. Quarter to date, Alphabet declined about 3%, but it's up about 9% this year or so. Also in the quarter, Berkshire boosted its stake in Delta by about 44% to hold more than $5 billion worth of the airline. The firm also paring back some financials exposure, selling a bit more of Bank of America as well as Ally Financial. Its Capital One holding was cut in half here, guys.
Yeah, it's interesting. I mean, the upsizing of the Alphabet stake is kind of notable. It's got big enough now that it actually has some heft within the portfolio. It's like maybe 10% of the overall equity holdings at this point. And, you know, as with Apple years and years ago, there was a little bit of an endorsement, I think, of the stickiness of the customer franchise. That was the whole premise behind Apple. I don't think they were making a technology call then or now, but it does seem as if they're pretty confident that there's lock-in within the Google ecosystem and whatever AI brings. We'll see if that's true. Plus, like $100 million in dividends too. That's what the other thing that Berkshire likes to do is collect dividends from the stocks it holds, not pay dividends to its own shareholders, and recycle that cash into whatever it feels.
I have to wonder too if the $10 billion private placement, maybe they wanted more. They probably wanted more. We're capped at $10 billion, which is kind of amazing. It was upsized at $85 billion.
Yes.
And they capped Berkshire Hathaway at $10 billion.
Although at last report, after the Alphabet earnings report and the call, they said that they had not yet done the other half of that 85, I think, right? That's an at-the-money equity offering facility. So who knows how much, if any, they've sold of that. But it does mean that Berkshire bought a pretty good chunk of what they have so far sold.
Exactly.
So.
This is so cool watching you just talk about Berkshire and tech and banking. Let's get a CNBC News update with Pippa Stevens. Hey, Pippa.
Morning, Carl. The president's son-in-law, Jared Kushner, in Israel today for talks with Prime Minister Benjamin Netanyahu as the Trump administration tries to push forward its peace plan for Gaza. The meetings come a day after Kushner met with the leader of Hamas, and just over a week since Netanyahu publicly rejected the 15-point roadmap that proposed Hamas disarm in exchange for an Israeli withdrawal from the Palestinian territory. Actress Hayden Panettiere, who was known for roles in such TV shows as Heroes and Nashville, has died. Her father made the announcement on social media. Panettiere recently revealed struggles with postpartum depression and addiction, which she said led her to give up sole custody of her daughter. The cause of death is under investigation. She was just 36 years old. And Sony announced that Spider-Man Brand New Day just crossed $2 billion at the global box office after just 3 weeks in theaters. That's the second fastest movie to hit that milestone, behind only Avengers Endgame, which did it in 11 days. Adjusted for inflation, only 8 movies have ever grossed more than $2 billion worldwide. Mike?
All right, Pippa, thank you. Up next, the real estate industry pushing back against New York City Mayor Mamdani's pied-à-terre tax. The CEO of Brown Harris Stevens joins us next with the impact on the Manhattan market. And then next hour, AI impacting nearly every industry, including boating. We'll be live on the open seas with a first-hand look at one of the most high-tech boats ever built. Stay with us.
Welcome back. Homebuilder sentiment ticking up a bit in August, but still pressured by high rates and economic uncertainty. Meantime, an appellate judge ruled last week that New York City Mayor Mamdani's pied-à-terre tax can continue while it faces a legal challenge. Our next guest says her firm is already seeing a chilling effect on New York City real estate sales from the tax. Joining us now is Brown Harris Stevens CEO Bess Friedman. Bess, tell us more about kind of the market implications you're seeing. And it's still kind of early days, right?
Yeah, I think it's too hard to, say what's going to be. But we have heard many stories now where sellers are like, okay, I'm going to sell this. I don't want to be here. I don't want to pay this surcharge. And buyers are hesitating a little bit until they know more. But the market has been really strong otherwise. June and July were great markets in New York City. So we're going to have to see. I think a lot of residents in New York were upset that they got this notice because they're primary residents. So they're saying this, guilty until proven resident. This is like the slogan. And so I think we have to have more discussions about it and wait and see what will happen.
Yeah, there's been a lot of confusion just about who will be subject to the tax, what constitutes, a second residence, to your point about the letters, even though someone may have a primary residence. How do you think that all gets sorted out? I mean, who do homeowners seek assistance from to even kind of navigate this?
I think they're talking to their lawyers and getting great advice about what to do. And there are, exceptions. So if you do own a second home here in New York City and you want to rent it out to someone who's a primary resident, you're excluded from the surcharge. Or if you have a family member that wants to live in the home, you're excluded. But I think the challenge has been this it feels like a political tax. And I think what we want to have is good housing policy, and we want to build more affordable housing versus sort of just go after people because they're wealthy. Because remember, in any city, you want to have people who have a lot of resources. They help everything. They help cultural institutions. They help restaurants. They help, construction work. Everything that you can imagine in a city that makes it successful. You need wealthy people who have resources and who are willing to invest. So we don't want to make them feel like outsiders.
I guess I just keep wondering how much it'll really swing the equation, because New York has never been a low-cost, low-tax place to have a second home. We have high hotel taxes because the people don't live here, and we can charge them whatever they'll pay. So I just wonder if you're buying a $10 million apartment, if the one-time surcharge, when you're going to be paying $100,000 in maintenance a year or something like that, it's really going to change the decision to buy or maybe impact pricing.
I mean, first of all, this is one of the pieces of confusion. It's not a one-time surcharge. It's every year. So you're paying your property taxes plus it's a tax that you pay every single year. So yeah, there are going to be plenty of people that are like, okay, I'll pay it. It's okay, I can afford it. But others may say, you know what, I'm just going to rent an expensive apartment, or I'll stay in a nice hotel. Yeah. So remember, as Charlie Munger said, people act on incentive or not. And so there are going to be people who decide that maybe they don't want to invest here. And so we're going to have to wait and see how that plays out. It's too soon to say, but it hasn't been received really well. I'll just say that in the real estate community.
Still, though, are we in a mode of seeing price cuts for things that are listed, or is that not happening?
Not really, because the market has been fairly flat. And in housing, it's like a tale of two markets. You have this uber wealthy market where people are buying. And then you have the first-time home buyer not able to afford their first-time home. It's like a K-shaped housing market. I was just talking to Robert Frank about it. It's, the rents have never been higher, and yet we have policies where we have rent freezes and the FAIR Act. And so, it's sort of like we have to get together. I don't care what flag you wave, just have good housing policies so that we can build more housing, make it more affordable for people so that they can buy their first time.
Although the city's building more units than it has since the 60s.
Yeah, we're building more, but we need to build even more.
Even more than that.
Like the City of Yes, which Mayor Adams got passed, was great because there's going to be 80,000 new units, maybe 100,000. We need more of that in a city like New York City.
What do you see as the big unlock then for the freeze that we're seeing? Is it just clarity on policy? Do we need to see mortgage rates come down? What is it that kind of unlocks this supply that's been kind of frozen in time, it feels like?
I feel like if we could just have some discussions and, get together with people who are experts on what will help to get more supply into the market, because we have a lot of demand incentives, but we need more supply incentives. So I think it'd be good if we could get together and not, it shouldn't be a partisan, it shouldn't be about politics. It should be about what can we do to make it better for everybody, because there's certainly huge inequalities in our housing market. And I know that the mayor wants to improve those. So talk to people and let's come up with good ideas to solve. Let's all get together versus sort of make it divisive. Like, you don't want to stand outside a billionaire's house and like point your finger at him. I think that's really unhelpful.
Are there other cities that you think are kind of a model for doing this in a positive, constructive way?
The pied-à-terre tax?
Or just, you know, making sure that there's housing availability, rental prices are stable, and people feel like things are affordable but also fair.
You know, I don't know of a place that's ideal in the United States. It's interesting, like if you think about Florida or even California, those places have similar struggles. So I think we have, it's an issue really across the country, which is why people can't buy their first time home. So I would love to be part of those discussions and help, because it'd be great. It's your future. It's like your economic security for everything if you have your first time home.
I do keep seeing maps of areas of the country where there is more price cuts than price hikes.
Yeah.
And areas like Dallas and Seattle and Denver and some areas of Florida keep coming up. Do you think that's going to accelerate?
It depends. I mean, look, those areas, a lot of those are dependent on mortgage rates. So, you know, when we talk about the super wealthy, like the mortgage rates don't really have an impact, but people who are buying their first time home or $1 million home, whatever it is, typically mortgage rates really matter. So I think if we can see rates come down a little bit, that will help to move the needle a little bit, which would be helpful. Because remember, there are a lot of sellers or owners of homes today that would have sold but decided not to because they locked in a 3% rate. They have that lock-in effect. So that's held back a lot of inventory as well.
Have you seen people migrate out to the suburbs or moving away if they feel like they can't afford rent or they can't afford a property in New York City these days?
Certainly. I mean, because the rents in New York City are, you know, at all-time highs. So people are finding going to New Jersey or other places so that they can, you know, afford to come into the city every day. Otherwise, it's just not sustainable. It's an interesting time in the housing market, I will say that.
Yeah, interesting, probably throughout, you know, post-pandemic, pandemic era. It's just
no, and besides the inventory issues, you know, there's this thing called private listings, which I don't know if you've heard of that, which is also creating more of a lack of inventory in a market like New York. So that's just another challenge.
You mean people are just working without a broker? Or?
No, there's firms that promote this sort of private listing network. Have you heard of it?
Wasn't there a story last week? You have to pay like $4,000. Maybe you'll get the shadow inventory.
You're in the know. So you shouldn't have to know someone to get access to inventory. And the House committee is investigating this. Senator Warren spoke about it. The president of the NAACP talked about it, about the implications for fair housing. So this is another concern that just adds, you know, more to the plate.
And why a seller would want to limit the available buyer pool, I don't understand.
Genius. Thank you so much. Exactly.
You'd want a true auction for your home.
Thank you. That's how the market works, and that's how you get price discovery. But there's some companies that think they can own the market by hiding inventory.
And some people like the idea of being part of an exclusive club.
Exactly. Exactly. You're a smart lady.
It works out well. Thank you. You too, Bess.
Thank you so much. Thanks, guys.
Thank you.
Still to come this morning, it was a somewhat disastrous rollout for Ferrari and those EV ambitions over the last year. But now, one of those very same cars set a record at auction. We'll talk about that. Speaking of EVs, Tesla reportedly working on a flying car in collaboration with SpaceX. Some details on that in just a minute.
As our country celebrates its 250th anniversary, CNBC spotlights the leaders driving business and the nation forward.
I think we're all part of an ecosystem, and I think that's what makes America great. I'm David Geckler. I'm chairman and CEO of SanDisk. It's not one individual company. It's not one individual person. It's not one individual innovation. It's everybody working together, everybody building on other ideas. That just creates greatness. When you roll that forward for 250 years, you end up with where we are today, which is a spectacular place to be. SanDisk builds semiconductor storage. Anything that you use in your life that's technology-based and stores data, that's what we build. It's really been this spectacular story over the last 3 decades. That removable card that you put in your digital camera, that was like the genesis of the SanDisk brand. I think innovation and technology have just played a tremendous role in shaping the future of the country. I think this is a big part of the American system that just relentlessly rewards innovation, risk-taking, and here we are at 250 years. Think how far we've come. And it's this kind of relentless drive to improve the future. It's this optimism that the future can be better, if we're willing to take risks in the present and we're willing to change things, willing to innovate. I think that's a story of American business. I think that's a story of America.
Welcome back. Ferrari's EV just setting a new record at auction after its launch in late May led to some of that backlash from the street. Robert Frank joins us with that story. What an evolution of this product.
Yeah, this is the other side of that coin. Total sales at Monterey Car Week smashing all kinds of records with sales topping $750 million. That was up over 50% from that previous record of $470 million back in 2022. Now, the big winner was this all-new Ferrari Luce. That's Ferrari's much maligned EV. It's the first Luce to roll off the assembly line. It was estimated at $1.1 million. It went for $40 million. That's 40 million. The buyer, we found out, was Herbie Wertheim. He is the billionaire founder of BrainPower Inc., which makes tinted lenses. The proceeds go to charity, so he also gets a nice tax deduction. The top seller of the week, though, was this 1964 Shelby Cobra Daytona that was owned by racing legend Carroll Shelby. Estimated at $25 million, went for $43 million. Lots of those stories over the weekend. And that McLaren F1 GTR is expected to be number one. That was owned by Pink Floyd drummer Nick Mason. Came in at the estimate of around $35 million. The biggest outperformers, though, were those modern supercars. 5 of the top 10 most expensive cars were made in the 1990s and 2000s. That's a big shift from previous years where most of those top sellers were the 50s and 60s cars. Now, for the full breakdown of the classic car market and the biggest auction week ever, you can sign up for the Inside Wealth newsletter at cnbc.com/InsideWealth. That'll be out on Thursday.
So you've done enough of these shows to notice when the attendee mix is shifting, is it?
It's certainly shifting, but this year I thought it would be an either or. In other words, the baby boomers were fading out, so those boomer cars wouldn't sell as much and they wouldn't be there as much. And these new collectors, it's both. The boomer collectors, like that 1960 Shelby Cobra that was the number one car, they're there, they're spending. Herbie Wertheim is an older gentleman. So you've got both generations now spending to the max for different reasons, and a lot of these young collectors, they're building $100 or $200 million collections in a matter of weeks.
Wow.
It used to take collectors a lifetime to build a major collection. Now these younger collectors are just, I'll take one of these, I'll take one of these, I'll take one of these, and then you've got the boomers also being selective and buying. So it's both.
You mentioned that the $40 million Ferrari EV was used for tax deduction purposes.
Not used for tax
well,
deduction.
The money
because
went to charity.
Money goes to charity. So if he chooses to, he can get a tax deduction. That's why when we have these rankings of most expensive X ever sold at auction, you have it in watches, you have lots of things. Some people remove those charity auctions because is it really a like-for-like comparison? Because really he gets if he wants to, probably a $13 million tax deduction off of that $40 million purchase. So what's the real price? So some people strip those numbers out of the rankings, but either way, the most expensive EV sold, the most expensive new car ever sold. And this will be huge in the debate over whether that is the ugliest Ferrari ever launched or whatever. Plus, we've got the fact that the company has said they're sold out. So they're sold out, and one just went for $40 million. How can you say that is not a success? That's what Ferrari will say.
How did they misfire on the estimated value? Was it just a placeholder $1 million?
They didn't misfire. What they probably did, and this is probably be the tax basis for it too, because you get the deduction of the fair value of the total auction price. So the fair value was probably $1.1 million. So the sticker price of an EV of a Luce is about $700,000. This was special paint, special this and that. Plus, it was the first ever made. So 1.1 is probably like the market value of that.
Got it.
And that's what they put it on. So they knew it was going to go for more. Estimates were, most people said it would be like 10 to 12. But 40, even the Ferrari CEO leapt out of his chair at that auction because he couldn't believe it. No one could believe it.
Yeah.
Tinted lenses, though.
I know. They're not all tech billionaires.
Who knew? And then maybe tinted windows
That's a
in
huge
the car,
TAM.
too.
Huge TAM, tinted lenses.
Yes.
Transitions, everything. All right, Robert, thanks.
Thank you,
Good to
guys.
see you. All right, we'll have a lot more coming up on the future of EVs when former Tesla President John McNeil joins us next hour to discuss reports that Tesla is planning a flying roadster. Plus, options traders making some bullish bets on some of the biggest chip winners of the year. We'll get to that. Let's go out in the street. Comes right back. Welcome back. Chip names getting a boost this morning, and the options market is pricing in even more gains for some of the year's biggest winners. Let's get to Oliver Rennick at Cboe in Chicago. Oliver.
Hey, Mike, semiconductors are trading the highest in a month as the data center memory trade finds its legs again, and options traders return to bullish positioning after a summer of sell-offs and heavy hedging in the options market. Look at SanDisk and Micron, the two superstar leaders of the AI bottleneck trade, up 40% and 20% in the past week as the DRAM ETF touches the highest in a month. Options flows around these favorites are exploding again. SanDisk and Micron have traded almost $1 billion each in options premium today already, and DRAM has traded almost double what SMH has. Calls outpace puts more than 2-to-1 in both SanDisk and Micron. But the bullish flows aren't contained just to the memory category. In NVIDIA, traders bought twice as many calls as puts, and in AMD, we saw one of the most bullish trades on the entire tape this morning. Someone spent more than $10 million buying out-of-the-money calls, $5 million on the 530 strikes expiring in November, and another $5 million on the 660s expiring in March. The bottom line, despite the pullback last month, chip bulls are alive, they are well, and doubling down on the names they loved in the first half, guys.
Oliver, good stuff in a very important space. That's our Oliver Rennick. Still to come this morning, one strategist lays out why he's still betting on biotech and defense to lead the market, even after the big outperformance versus the S&P so far this year. More Squawk on the Street after this. Good Monday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Leslie Picker here at Post 9 of the New York Stock Exchange. Sarah Eisen is off today. We'll speak to a top market strategist this morning about why he's bullish on the biotech and defense sectors right now, plus the key catalysts that he's watching for in this market.
Then former Tesla president John McNeil will join us. That says Tesla reportedly plans to unveil a design for a flying roadster. How that could set the stage for further integration of Tesla and SpaceX.
The president of OpenAI addressing those recent departures from the company for the first time this morning. On Squawk Box, we'll get you those comments, plus what he's saying when it comes to AI security. As for markets, a little bit of softening here after 3 straight weeks of gains. We're back to 77.73. VIX is still sub 15. Energy's given up some gains this morning, and so have yields. We did get to almost 5.29 on the long bond, coming back just about a basis point or two.
We'll start with the latest developments on the war with Iran. Eamon Javers joins us now. Hi, Eamon.
On social media yesterday, signaling a pivot away from U.S. ally South Korea and announcing he has scaled down planned joint U.S.-South Korean military exercises. The president cited warming relations with North Korea as one reason for the shift. He wrote on social media, these exercises are not only costly, with much of the cost paid for by the United States as usual, but send a signal that is totally inappropriate and hostile to a country that, as long as Donald J. Trump has been president, has been unthreatening and respectful. Trump also cited South Korea's lack of cooperation in the military campaign against Iran as another reason for his shift, writing, I recently asked the president of South Korea if they would like to join us in the denuclearization of the Islamic Republic of Iran, and they said, no thanks. Meanwhile, in a comment to Fox News this morning, the president threatened to, quote, bomb the S out of Oman if that country gets in the way of U.S. efforts to reopen the Strait of Hormuz. Now, Omani negotiators have been in conversations with Iran about a new regulatory regime for that crucial strait, an agreement that reportedly could include fees or tolls for international shipping. In response to the president's comments, a senior Middle Eastern diplomat with direct knowledge of the talks told MS Now's Ian Sherwood this morning that Oman is focused on working toward a solution that leads to the reopening of the Strait of Hormuz. It's their primary objective, this official said. That comment, guys, though, doesn't really respond to the thrust of the president's criticism or indicate if the Omanis are likely to back off this emerging agreement with Iran. So for now, it is still an open question as to who's going to control that strait, what the tolls will be, and whether it'll be in U.S. favor.
Yeah, there are a lot of open questions. Eamon, this also ends the 60-day ceasefire between the U.S. and Iran. What happens now?
Well, that ceasefire was largely defunct anyway. I mean, all sides had acknowledged that those talks had broken down. The president signaling in his interview with Fox News this morning that, there might be some back-channel communications with the Iranians. So presumably on some level, there is some contact still between the United States and Iran. We haven't seen those stepped-up attacks by the U.S. in recent weeks. So there is sort of this cooling off period. And the president had suggested that he wants to kind of just muddle through with the Iranians. So we may be in a situation, Leslie, where the situation kind of doesn't resolve itself for months and months. The president signaling on television this morning, he's fine if this goes through the midterm elections in November. So I think what had been billed as a 4 to 6 week excursion, as the president put it, obviously now he's contemplating going through the latter part of this year with this situation unresolved. I think markets should start to expect that this doesn't get resolved anytime soon.
Yeah, interesting to see Brent, especially, Eamon, refused to really crack 90 on the upside, even with this discussion now of a longer duration excursion, as you put it. That's our Eamon Javers. Thank you. Let's stick with Iran and the energy markets. Joining us this morning is Bob McNally, founder and president of Rapidan Energy Group, which we've leaned heavily on since the early days of the conflict, Bob, when you actually said there was a good likelihood that eventually the Houthis, for example, would get involved, and that's now a material element of this entire conflict.
Carl, great to be with you. Yes, the conflict's spreading. It was just a matter of time for the Houthis to get involved. So now, while we have some good days in terms of getting some more oil out of Hormuz, we're getting some transits up to, on a given day, maybe 9 million barrels a day, maybe 7. But then that's offset by a loss from Yanbu. It's also spread Carl, to Russia. We were saying that the Ukrainians are going to take down so much refining capacity in Russia that the world's second largest diesel exporter, Russia, after the United States, was going to have to reduce and now ban its exports. And so just this morning before we went on, the margin of turning crude oil into diesel fuel took out $100 a barrel itself. That's just the margin. So it's a historic day, and the conflict is spreading. It's not just about Hormuz anymore.
Yeah, those diesel crack spreads, a big discussion late last week. I think it was Goldman that said maybe diesel is the ultimate geopolitical hedge. Do you consider it sort of the locus of pain around the world?
It is. It is because diesel is the most economically embedded fuel we have. My friend Kevin Book was on with you this morning today, and he pointed out, and he's right, it's in transportation, it's in heating fuel, it's in agriculture, it's in industrial uses. Diesel, gas oil, it's the most widely sort of economically used fuel. Gasoline's great. We all talk about gasoline because we all tank up. But around the world, the main product is diesel. So it is the important macro fuel to watch. And again, it is taking out $100 a barrel margin, all-time historic high, and still rising.
Meantime, there are some headlines over the weekend about just this rapid drawdown that we've seen of the Strategic Petroleum Reserve and what the depletion mean to the caverns, what it means to operations, what it means to the price of fuel. What's your take?
Well, yeah, you know what? I hope when we go back and look at lessons learned, I mean, what folly it was to drain the SPR for no good reason just before the largest geopolitical energy disruption in history. I think we're going to go back and look and not do that again. But we're well below 40-year levels, we're now below 300 million barrels. I think it can get down to about 170 million barrels. I hear talk out there, Leslie, at 250 million barrels. There's some sort of law that says the president can't go below that. Baloney. There's laws that apply to specific weaker uses of the SPR, but President Trump, with a stroke of a pen, can draw down every drop he wants, and we have roughly 300 million barrels. However, I think below 170, you start to get concerned about the caverns, the integrity of the spaces, so I think they'll be cautious if we go below 170.
Yeah, a lot of discussion about the operations and how these caverns work at low supply levels. The other big question, Bob, is China. The tape seemed to suggest the other day that they might be looking to start to refill some inventory. You think that's true, and what would it mean if that continued?
Well, China is definitely coming off of its crash diet, and China's crash diet, meaning their abrupt dropping by 4 or 5 million barrels a day of crude imports, was the unexpected thing that helped keep Brent contained, as you noted just a minute ago, Carl. So now we don't think China's going to go heavily back into SPR filling yet. It had been filling over 1 million barrels a day, 1.5 million barrels a day. It stopped that. It's drawing modestly right now from inventories. We think they are going to start importing more, not necessarily to go gangbusters on SPR. We think that's next year, but they're going to let their refiners earn some margin, right? The refiners around the world, Christmas is coming early, and everyone's getting rich if you're a refiner. And so the Chinese really cut their refining exports off. They limited it. So they're going to allow more imports so their refiners can start capturing that market. We think they'll be up about 2 million barrels a day. And China, coming off of its crash diet, is not consistent with Brent prices being stable. As we run out of SPR buffer and China comes off its crash diet, if Hormuz remains largely disrupted, crude oil prices, we think, will follow refined products higher.
Right. So what levels are we talking? What would you be eyeing on Brent?
Well, I think on a daily print, I think we're going to go over $100 a barrel. I think at the very least, I think quarterly averages, the high 90s, 100. I think the risk to that, because whenever I make a forecast, the only thing I know is it's wrong, just like everyone's forecast is wrong. You say, where's the risk skewed? I think it's towards higher Brent prices, not lower. But I'd sort of be looking at the high 90s on a quarterly average at the end of the year with daily prints well above 100.
Yeah.
In your latest note, you note there's a 35% odds of U.S. oil export restrictions. That's something that the energy companies don't want to see happen. So far, the administration has not indicated it wants to do this. At what point, at what threshold do you think that ultimately becomes more of a reality?
Yeah, I've worked in the White House with President Bush. I know what happens when the walls start to close in. People start to do and think about crazy things. And if gasoline prices, which are now just above $4 per gallon average, if they head towards $5 or above, higher than they were under the record of President Biden in 2022, if we start to see equity markets pay attention to oil, which they have not been, or bonds pay more attention, if oil becomes a significant macro problem for the president, which so far it has not been, then I think they are going to consider export restrictions. There will be some in favor of it. The administration has said over and over again, we won't do it, we won't do it. They promised from the president on down, and I believe they know it is a dumb idea. But dumb ideas come to the fore when the walls start to close in. And even to get a brief drop in pump prices, it's something that might look at. That's why we're at 35%. And if our forecast is too low and oil prices gallop towards $150 a barrel crude, we think the risk to that 35% will be higher, unfortunately.
Wow. That would have big ramifications for production here domestically and maybe stock prices too. Bob, next time let's talk some European gas going into the winter as well. Good to have you.
Thanks, Carl. You bet.
Bob McNally.
We have a news alert. Synchrony Financial, the credit card issuer for brands including Amazon, Walmart, and Lowe's, is working with OpenAI to allow shoppers to make purchases directly inside ChatGPT using their Synchrony cards, CNBC has learned. The deal is one of the first major moves by a U.S. consumer lender to bring financing and payments directly into the AI chatbot. The company says getting cards integrated into ChatGPT could take 6 to 12 months, with private label store cards taking longer. Synchrony is also in talks with other AI platforms, including Anthropic's Claude and Google's Gemini, about embedding its cards in those chatbots. You can find out more at CNBC.com, but clearly part of that backbone of e-commerce and AI, which a lot of the retail industry sees as kind of the next leg or the next move in the AI ecosystem.
There's no part of this economy that it's not influencing, that's for sure. When we come back, Miller Tabak's chief market strategist will join us, why he likes biotech and defense sectors right now.
Plus, we'll take a look at the top shareholders in SpaceX, according to new 13F data, as that stock jumps to start the week. Squawk on the Street, we'll be right back.
That's right.
Welcome back. The major averages are mixed this morning, though still just a few points off of record highs. But our next guest is telling investors to watch chip stocks more closely than anything else as we head into seasonally rougher period for stocks. Joining us now, Miller Tabak Chief Market Strategist Matt Maley. Matt, thanks for taking the time. So are you concerned about chips and the way that they've been leading the markets to the upside?
Well, Leslie, it's, obviously it's been the key leadership group. I mean, this has been the case for decades. I mean, it's not just since the AI phenomenon became such a big issue in the last several years. But, it led the way higher as we moved out of the scare we had, of course, in March with the war. And but then, it got hit quite hard. And the thing that makes me concerned is that even though it's bounced quite nicely, it has not retraced anywhere near as much of its decline as we've seen in the S&P and other key indices. And that's what we've seen in the past when a nice bull market. And I would hate to say in 2000, a bubble burst. We had a feeble bounce back in the chips in the chip stocks, even though it seemed strong on a percentage basis. It lagged the rest of the market and then rolled back over, and that was the end of things. So I'm not saying that's definitely going to happen. I'm a little bit worried about the way it's been lagging lately. So we definitely need to see this group push higher again, and tape back its old highs and confirm the new high in the S&P 500. If not, we got problems.
When you see reports, though, from an OpenAI or from an Anthropic about the run rate, their growth rate, is that a tell for the market, just given how much of the ecosystem is based on these two companies performing well?
Well, it's something that is certainly helping the group, and we're seeing that today. But it's interesting that it's not really moving as much as we again, as much as the rest of the market has. And I guess my biggest concern is that when we see tops, especially important ones, especially when the market is as expensive as it is today, everything looks good. Earnings look great in the beginning of 2000. Earnings look great at the beginning of 2007. Same thing with the economy. But when things turn south very quickly, the situation changed very quickly. And with these, the big thing for the AI phenomena is we have these continuing capital requirements, and that we haven't had in other big technologies that have changed the world over the years. And so, I'm a little bit concerned about what's going on, especially since we're seeing a rise in interest rates that is quite stubborn, even though we've seen some weaker data on the economic side.
I was going to say, we've been watching this steepening after weak, actually negative jobs number, Matt, then a tepid CPI and a tepid PPI, and then a not so great retail sales last week. Short ends come down, but I think, what do you think is at work on the long end?
Well, the biggest concern is that, we for decades, of course, all economists have been talking about, focused on the economy, inflation. What does that mean? And if you got that right, you got the direction of interest rates correct. But Carl, more recently, we're now seeing that investors are demanding to get paid more for the risks they're taking to own sovereign debt, not just here in the U.S., but in places like the UK, France, Japan, et cetera, because of these massive levels of sovereign debt and massive budget deficits. And so if we have to start focusing on those things, and if inflation is improving, but rates don't come down because of these budget issues, that changes everything in a major way, because the stock market's been able to ignore these higher interest rates for a while now, but history tells us when interest rates move higher for over an extended period of time, eventually they do have a significant impact on the stock market.
The markets, for much of the last few decades, have also ignored the trajectory of the debt. And I'm curious what you think is different this time. Last night, we crossed that $40 trillion threshold for U.S. debt. There's also the prospect of the tariff refunds potentially playing a role. Why do you think, what causes the long end to sit up and pay attention?
I think a lot of it has to do with what's going on overseas, particularly in Japan, because, they are in a situation where they, 250 times GDP. I mean, it's just getting out of control, and yet they have a new government, very a charismatic leader, but she wants to, add more debt, and we have the same thing in this country as well. And we get to these kind of levels, No, interest rates keep pushing higher and higher. I mean, you look at the incredible rise in interest rates overseas there in Japan. It's got people focusing on this situation much more than they have in the past. I mean, Dick Cheney said that deficits don't matter. That was 25 years ago or 20 years ago. They're starting to matter now, and this is something that people have to pay attention to because it's just that, this whole issue that, geez, interest rates were a lot higher back in the 1970s. That doesn't really matter. I mean, a family who just had, a family of three who just had a second child, at 6% mortgage rate, they could afford a house. And now that it's close to 7%, they can't. They don't care what their grandparents paid for their mortgage rate.
Yeah, no, it's a good point. And obviously an interconnected world with a global phenomenon in terms of deficits. It's clearly going to be one of the enduring stories, at least of 2026 and beyond. Matt, thank you.
Thank you, Leslie.
Still ahead this morning, former Tesla President John McNeil's with us. We'll get his take on this new report saying that Tesla will soon unveil a design for a flying roadster.
Plus, what does the future of TV look like? We'll bring you key predictions from top media executives about what they think will become an industry standard in 3 years. We're back in a moment.
Welcome back. Let's get to some movers this morning. Memory names like SanDisk and Western Dig popping after the Commerce Secretary says the Trump administration urged Apple not to buy memory chips from China. Meantime, shares of oil producer Vista Energy are higher after it was revealed that Peter Thiel's hedge fund acquired a stake in the company worth about $76 million. And shares of Snap have had a tough morning. Investors focusing on a recent court ruling that will allow more than 3,000 consolidated lawsuits against Snap and some other social media companies to move forward. Also, Snap CTO selling 4 million shares worth just over $21 million.
And from social media to traditional media, our Alex Sherman spoke with top media executives about what they think will be standard for the TV industry in the next 3 years that doesn't exist today. Here's what they said.
Personalization exists today, but I'm going to say 3 years from now, you're going to see it pretty much everywhere, meaning networks are providing the right content to the right user at the right time.
I think you'll see ads get way more useful and relevant the same way they have on social media. If you think about the experience today on television, it still largely feels like the ads are not personalized. And you can imagine a world where you can see such hyper personalization that really it gets to a place where what you see as an ad doesn't even feel interruptive or like friction. It actually just feels like, wow, that was really helpful and useful because you know me so well.
Alex Sherman joins us now to discuss. Alex, it sounds like personalization is kind of the main part of the crystal ball here. Is personalization more lucrative for the business models, presumably?
Yeah, I mean, we've been hearing this for like 2 decades, Leslie. So I'm not saying that these media executives are wrong, but what I am saying is that this sort of holy grail of hyper-personalized ads, so that TV ads look more like digital ads and so that you can have sort of, interfaced commerce between the TV screen and your remote control or your phone. This is what the industry has wanted literally for 20 years. There has been a number of different ventures to try to get us here. I will say that we do seem to be closer than ever to this. And for sure, it is a lucrative part of the business model because every advertiser wants to know exactly how effective their TV ad is. They spend a ton of money on it, particularly, say, during the Super Bowl. So there's no doubt that this is where the industry wants to go. Really, the only doubt is how long will it take to get us there? And by the way, that was just one of 5 different questions that my colleague Lillian Rizzo and I asked 10 different TV executives for this longer project video that's out on CNBC.com. It's actually something we did 3 years ago first, where we asked a bunch of TV executives the same questions to try to get their on-the-record responses for how they were thinking about TV in 3 years. So this is an update now to that 2023 story we did, where we asked 10 media executives, some of them the same, some of them different, the same 5 questions, and we had them all answer them. And like I said, you can find that video on CNBC.com and watch the full thing. That clip you just saw was just a small snippet of the full video.
It's really cool stuff, Alex. Does it mean that you won't continue to suss out anonymous predictions from media insiders?
I will still do that at the end of the year. I don't want to give away too much about who my sources for that are, which, by the way, they change every year. But I will say that there are a lot of TV executives. So at least a fair amount of the people, if not all of the people in this video, are not the people that I use for that anonymous sourced story toward the end. I'll keep you guessing with that one.
That's where it gets really juicy, and it's also fun to go back and look, as you often do, to see whether or not some of their predictions were even close to being accurate. It's nice to see this on-the-record stuff, too, though, Alex. Thank you, Alex Sherman, this morning. Let's get a news update with Pippa Stevens. Hey, Pippa.
Court today denied for a second time the president's attempt to overturn the verdict where a jury awarded $5 million to writer E. Jean Carroll for alleged sexual abuse and defamation. The president asked the court to reconsider its June decision that initially rejected the appeal. The court almost never grants such requests. British Prime Minister Andy Burnham reportedly exchanged messages with an imposter posing as White House Chief of Staff Susie Wiles. Politico reports that Burnham became suspicious and cut off communication. Last year, the U.S. government investigated a series of imposter messages posing as Wiles and sent a warning to diplomats of attempts to impersonate top U.S. officials using AI. And the U.S. will reportedly tell countries around the world they need to pick a side in the AI race with China. That's according to a Reuters report. It cites a draft State Department letter to about 36 countries saying they'll be excluded from a U.S. AI coalition if they also sign up for a competing initiative spearheaded by China. Leslie, I'll send it back to you.
The bifurcation continues, Pippa. Thank you. Still ahead, who are the biggest shareholders in SpaceX? Well, we'll take a look at what the latest 13Fs reveal.
A new report says that Tesla will soon unveil a design for a flying roadster. We'll talk about this latest ambition, what it means for the company with Tesla's former president, John McNeil, when we're back in a minute.
Welcome back. SpaceX went public 2.5 weeks before the end of the second quarter, meaning the recent 13F filings were able to give us a sense of who the biggest holders were after that record-breaking IPO. Google's parent company, Alphabet, had a stake of more than 7% of shares outstanding. That was worth a whopping $94 billion, an incredible on-paper return after investing $900 million in 2015. Antonio Gracias' Valor held about 6.5%. Fidelity, GigaFund, the Sovereign Wealth Fund of Saudi Arabia, and Ron Barron's investment firm each held around 2%. That equates to about $30 billion apiece of the company's current $1.8 trillion market cap. D1 and NVIDIA also hold substantial ownership of SpaceX. For D1, it's the firm's largest long equity position, comprising nearly 2/3 of the equity assets in the portfolio, according to the firm's 13F. These filings are snapshots as of the end of Q2, and the positioning may have changed in the 6 weeks since, but perhaps even more interesting will be the revelations from next quarter, when we start to see who chose to sell and by how much as the lockups begin to expire, Carl.
Right. We mentioned with Jim this morning, we're going to get another one on the 20th, which I think is, what, Thursday or something like that?
Yeah.
But billions or more shares by year end.
Yeah. And you have, I mean, D1 is one example. I don't know if that firm plans to sell, but it is the firm's largest holding. They're very overexposed to SpaceX, and they're not the only one. There are lots of firms like that that bought in early, and of course, with the price appreciation, at least on paper, you're, very overexposed to one equity. So how that kind of changes the calculus? Do you do some sort of other financial engineering to maintain your exposure, but, pare back maybe your notional exposure is a question. So, it'll be really interesting to see what those third quarter filings reveal. I'm looking forward to that.
I mean, when the company's been around for a couple of decades, you have these holders who are so deep in the money, it would be irresponsible in some respects not to unload some.
Exactly. It's portfolio management. I mean, they have LPs they have to answer to. It's not just about this one bet and the relationship with that company.
Fascinating. Also in Musk's orbit today, Tesla reportedly planning to unveil its new Roadster design and could do so as soon as this month. That's according to the information. Tesla is expected to show off the vehicle's flying capabilities, which were reportedly made possible by a collaboration between Tesla and SpaceX. Let's bring in Jon McNeill, former Tesla president, co-founder, and CEO of DVX Ventures. McNeill also previously sat on the boards of GM before stepping down earlier this year. It's great to have you back. Thanks for the time this morning.
Yeah, good to see you, Carl.
So this came out of a piece in The Information, and if we do get an unveiling, I wonder whether you think it's feasible, or is it more about just wanting to be aspirational in their product design?
Interestingly, the idea for the SpaceX thrusters actually came out of the first brainstorming meeting we had for the new Roadster back in 2016. So this is an idea that's been around from the beginning 10 years ago. And the original idea came because we wanted to produce the fastest production car ever. And to get speeds of 1.6 to 1.80 to 60, 1.8 seconds, we needed the thrusters. I think the new idea is to point those thrusters at the ground and add another feature, which is hovering. So I don't know if we're going to see flying, but we may see hovering in this demo.
Fascinating. I mean, can you talk a bit about what role in this SpaceX plays?
Yeah, they have the thruster technology. They've got this cold gas technology that would provide enough thrust to cause a car to hover. And I think, Elon recognizes that Tesla needs to inject some energy and excitement back into the car business, and the Roadster is a natural way to do that. I think this is also probably not a not so hidden attempt to further knit Tesla and SpaceX's futures together.
Yeah. Do you think this increases the odds or likelihood, and how would you handicap them of those two companies combining in the future?
It's a good question, Leslie. I think if you step back, Elon's got hundreds of millions of reasons to do this. If Tesla and SpaceX combine, he's well on his way to his $1 trillion payout thresholds. And the engineering is much closer in terms of what Tesla does and what SpaceX does in AI. The Tesla autonomy really depends on the AI. The chip making depends on SpaceX's AI Terafab. And so I think it's just natural for a number of reasons that these two businesses are going to come together, probably sooner rather than later.
There's some discussion, John, about if whether or not Musk's businesses are getting less green. In other words, you're using a thruster to elevate a car. You're using a gas turbine to fire some of the build out. I mean, are you thinking is there more space between the business model and what might have been a climate story from legacy Tesla?
It's a good question, Carl, and I think it's problematic to a number of folks who joined a company that was on the forefront of new energy and on green, and so there is this new commitment to fossil fuels to fuel the AI data centers, and I think that does change the messaging around the company from being a climate leader and now really going all in on fossil fuels to power their AI data centers.
I also have to wonder, you mentioned this idea that the flying car idea will inject some energy and excitement back into the car business. What about the regulatory side of this? Is this something that you think is many, many years in the future, given just the regulatory appetite to have hovering cars, especially at the speeds you're describing?
Yeah, I think, Ferrari has a significant business of cars that are not street legal. They are sold to enthusiasts and can only be used on a track. And I think you're going to see the first version or maybe versions of the Roadster potentially not being street legal. I'm sure they'll have a street legal version, but in terms of the hovering and thrusting version, I'm pretty sure that won't be street legal. And what they'll do is they'll wait for the regulators to catch up, or they may push the regulatory framework a bit to get it to accelerate. But I think you're going to see that there's a non-street legal version that's going to drive a lot of interest and a lot of buzz around this new Roadster.
As that often does.
Yes.
How would you grade them in their contest with Waymo on autonomous in terms of rollout, number of cities, number of miles, number of trips?
Gosh, I would rate it not even close. It's a blowout now for Waymo in the sense that they've got thousands of cars versus dozens. They've got tens of millions of miles under autonomous fair earning rides versus just a couple 100,000 miles for Tesla. So I think right now the race is going to Waymo, and Waymo is way ahead.
Yeah. Have you been impressed though with municipalities' willingness to sort of embrace some of this stuff?
I have. I think as a municipality, especially if you're into tech, you want to appear as tech friendly as possible. And it's market when you land in San Francisco or land in Phoenix or land in Austin or LA, and you can hop into an autonomous car. And when you land in Boston or land in New York or land in Washington, D.C., you cannot. And that really sends a signal about the appetite to both attract and promote technology by these municipalities. So I think it's really good branding for these cities to be autonomous friendly, because it really does send a very visible signal to their openness to new tech.
I don't know how willing you are to talk about the GM days, but this sale of this battery venture to Samsung adds another chapter to sort of this new strategy when it comes to electric. I wonder, just where do you think we are on that stage among some of the legacy OEMs?
I think in GM's case, they've made a real commitment to having best product in each category, from luxury SUVs down to the smallest and least expensive EV, the Bolt. And what they're doing is right-sizing to demand. They see a huge demand spike for data centers and for the grid, and so they've got battery capacity. They're moving towards those needs, and they see lower demand in EVs, and so they're shifting their production capacity, because they've got a lot of it, from EVs to now the grid.
Yeah, well, it's good to see that some of this stuff can be repurposed as business models evolve. You can say the same thing about crypto, too. Fascinating, and we'll see what we get out of the Roadster. John, as always, good to see you. Thanks.
Good to see you too. Should be an exciting week.
Yeah.
Feels like the Jetsons in so many ways. Coming up, the president of OpenAI gives his first comments on the company's recent executive exodus. That's right after this break. Welcome back. Welcome back. OpenAI's president speaking about recent departures from the company for the first time on our air this morning. Kate Rooney has the details. Kate.
OpenAI co-founder and president Greg Brockman really brushed off some criticism about recent executive departures, namely Chief Revenue Officer Denise Dresser, who announced last week she was going to be stepping down. Here's what Brockman told Andrew on Squawk Box.
I'm a constant, Sam is a constant. I actually think that the difference between OpenAI and other organizations is that we are so much in the spotlight, so every departure gets scrutinized in a way that it doesn't otherwise.
Dresser, who I mentioned, is part of a string of high-profile exits that we've seen in just the past 6 months or so. Brockman, in that interview, also confirming some of our reporting from an investor meeting on Friday. He said revenue grew about 20% in July. Enterprise revenue, in particular, was up 32%. His big focus of this interview was cybersecurity and some of the risk to corporate America. He says that human-written code is full of vulnerabilities. He called it tech debt. Cyber, of course, has been one of the biggest topics, and AI, especially after those high-profile issues with AI agents from OpenAI hacking into startups. Guys, we did also hear from Anthropic CEO Dario Amodei in a very rare tweet over the weekend. He was responding to some of the widespread criticism out there that he has been overly pessimistic about some of this technology. That's adding to some of the widespread mistrust of the industry. Amodei, in this tweet, says, quote, "I do not agree that my messaging has been disproportionately negative." He argues that he's been equally balanced between some of the risks and benefits. Says, "I do agree that the public has a negative view of AI and that this is a big problem, but I don't think it's primarily caused by me or any other AI leader," warning about AI's risks. He calls it a crisis of trust. He says they also haven't delivered on some of the big promises to benefit the world. He talks about drug discovery in particular on that topic, guys.
Yeah, certainly. I mean, our discussion with Jim this morning in the 9 a.m. was about sort of these large AI labs saying, trust us when it comes to safety, and now arguing that these bad actors inevitably will have control of some of these models.
It's interesting. One of the questions, too, that Andrew tossed out, I don't think we got a clear answer on this, but the criticism has been that this is marketing, that they're saying, hey, cybersecurity is so risky that you need to buy more of our technology. From what I've also heard, Brockman has told some of the investors in OpenAI behind the scenes that cybersecurity is a huge enterprise opportunity. So they see it as both. That might, doesn't need to be both. It can obviously be a risk and also a business opportunity. They've been banging the table, but clearly an issue here for enterprises. And when you say tech debt and there's companies out there with a ton of vulnerabilities, it raises alarm bells, and we've seen a lot of companies try to get ahead of that. He sort of described this as a moment where companies still have an opportunity to get ahead before some of the bad actors do. And before this technology really is ubiquitous, OpenAI and Anthropic might have a little bit of a jump start on some of the open source models, but from what we're hearing, they're not far behind. It's maybe a matter of months.
Kate, I'm curious what you make of the high-profile departures and Brockman basically saying it's not that big of a deal, it happens all the time. Have we seen something similar with Anthropic, which is also confidentially filed to go public?
We have not, Leslie. It's a very different company in that sense, and folks that I've talked to that are close to OpenAI, especially investors, have said that this is the company, this is the culture. Some of the turnover and volatility is expected. Somebody called it a hire fast, fire fast culture. So if one thing is constant about OpenAI, it's that you're going to have a lot of volatility, whether that's executive turnover, whether that's the culture in general and how quickly they move. A lot of folks that I've talked to just expect more of this going ahead, but I think the important thing ahead of an IPO is that they do have their team in place, that it is Greg Brockman, it's Sam Altman, and Sarah Friar is the other important executive that investors look to, who's really been telling the story of the revenue growth and trying to frame all of this to Wall Street. If you see any of those three go, I think that would be the big one. Aside from that, I think it's sort of all systems go to the IPO, but if any of those three left, I think it would really, really raise some alarm bells.
Yeah. Kate, interesting days. We're counting. We're watching the calendar here. That's our Kate Rooney. Watching the large models and the AI labs. When we come back, AI is heading to the high seas. Our Contessa Brewer with an inside look at new technology used for boating. Contessa, what's coming up?
I have a global exclusive first look for you. The kind of advanced tech on the Sea Ray that allows me to be at the helm. You can call me Captain Contessa. But look, Ma, no hands. Why it matters for the bottom line. It's all coming up after this on Money Movers.
Welcome back. As you saw before the break, AI technology now making its way to boating. Our Contessa Brewer joins us with more. ACB.
Okay, so 36-foot Sea Ray here, Carl, and this is the deal. Just last week, Sea Ray launched for the first time ever autonomous docking. So only a few select investors have had this view. I'm going to show you now. This is the first exclusive global look. Here's our boat's position in the marina at Brooklyn Bridge Harbor, and I've put the boat right here. I've dragged it here into the slip. This is the most stressful part for any boat captain, is getting the boat in and out of the slip. Now, watch, with the touch of a button, all I'm doing, start docking. And while this takes over now, I can explain to you that Sea Ray's parent company, Brunswick, is making a bet that all of this technology can help them with profits, even if boat sales are sluggish. Now, I'm going to walk away from this. And as every good captain knows, you never leave the boat unhelmed. So Captain Joey's going to take over for Captain Contessa. The one thing I can explain to you is that if the boat is coming in, autonomously docking, Brunswick thinks that they can get people to buy more, invest more in the technology, in the accessories, the motors and the engines, of course, and then recurring revenue. So, for instance, they have 450 boat clubs around the world, Freedom Boat Clubs, that operate like country clubs. You can buy a membership and go in and use the boats at any of their 450 clubs around the world. In this particular case, if you buy a Sea Ray, they think that they can get you to spend more money if you know that the bells and whistles that come on board, much of it assisted autonomously, and I know because I took it out for a spin in New York Harbor, will help you have a far freer day out on the water, a less stressful day. I asked the CEO, Dave Folks of Brunswick, about this because, let's face it, over the last couple years, their shares have been relatively flat. You want sort of calm water out on the marina, out in the harbor, but not necessarily with your stock shares. And he's making an aggressive target, $8 to $12 a share by 2030, in large part because now 60% of their earnings are coming through either this aftermarket accessories or the recurring revenue. It's a big bet in boating, guys.
Contessa, you cover the insurance industry. Is insurance cheaper for an AI-powered docking system like this, or would insurance rather a human be at the helm?
You know, it's so interesting that you asked that because we've seen this in cars, right? When you have autonomous vehicles, insurance right now is holding back off of saying you get a break for this. But when you buy a car that is equipped with lots of safety features, often supported by AI or autonomous programming, that you do to get a discount on a car that is equipped with safety bells and whistles, as opposed to you're a human and there's no reminder that you're starting to veer off the road.
Man, I can't take my eye off the screen watching it dock like that in one of the most stressful parts of boating. Really quick, Contessa, pricing on this product?
Oh, that's a really great question. Captain Joey's also the head of product for Sea Ray. How much is this baby going to cost you?
So it starts around $550, but as it's loaded without the auto captain, it's about $860,000.
And what are you finding your high-end customers, where the high-end, as we've heard from everything else, is holding up better, but high-end customers want this on the boat?
Oh, absolutely.
Yeah.
We've had many requests.
Thanks, Joey. Thanks, guys.
Amazing.
Thanks, good job.
Contessa Brewer on the water. See you tomorrow.
See you tomorrow.
Let's get to the judge.
Good.
All right, guys, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, this record-setting market. Stocks on a 3-week winning streak, but are investors growing too bullish? We'll ask the committee. Joining me for the hour, Joe Terranova, Shannon Sikocha, Jim Leventhal, and Stephen Weiss. Check the markets here. We obviously have a little bit of a give back today on everything but the NASDAQ, which is green. So we're 3-week winning streak. The VIX fell to its lowest level of the year on Friday. Every sector within this market is now in the green for the year. Ed Yardeni had already taken his target to 8,400 for 2026, says we're going to 10,000 or beyond by the end of the decade. The roaring 20s in full effect. Why? Because earnings are amazing. Evercore this morning. Long-term stock market trend continues to be higher. We have the potential for a FOMO-driven overshoot. SPX 9,000 is attainable in the next 12 months. Even if you don't overshoot on a valuation standpoint. Joe, what say you?
I think you get to 10,000 in the next 18 months. I see no reason why not. I agree with the representation of earnings being at really a historic pace for the last 7 quarters. The market is kind of settling in as you move towards the back end of August. I think I'm hearing a lot of people say, okay, look at the market and maybe this is the opportunity to sell. There's universal bullishness and that's the reason to sell. And I couldn't disagree more with that. I think really what's happening as you move towards the end of August is the market's becoming more tactical. Okay, the market is identifying opportunities and maintaining those opportunities. So memory came back last week. Optical came back. We're maintaining that position. We're rebuilding positioning. The bullish momentum remains in place. Energy, we've spoken about the refiners. Same example there. Rebuild positioning, maintain positioning. And then financials. Look, once again today I'm looking. You've got Bank of America, 52-week high, State Street, Charles Schwab, PNC. So there's strength in financials as well. The market is more tactical. And just because it appears as though maybe volatility and the environment is a little bit slower, the market's not moving as fast, that is not a reason to sell. That's actually indicative of a market that is waiting to reaccelerate as we move into the fall and broaden out once again.
Okay. Thankfully, Weiss is not maintaining his positioning because he is no longer blending in with the wall. So we appreciate that. Appreciate you putting a new piece of art up, Weiss. What about you on this market? Yardeni, 10,000 by the end of the decade, 9,000 by the end of in 12 months for Evercore, 10,000 from Terra Nova. People are pretty bullish. I asked a question, too bullish or just right?
You know, I'm bullish as well, and I tried to think of what can derail the bullishness. We know earnings are good, and there's every reason to believe they'll accelerate, a lot of it driven by AI. So what are the obvious things that could hit it? Number one, if rates go up measurably, if the Fed starts tightening, and that'll be because of oil, or the consumer, which is still 2/3 of the economy, starts to weaken further. Now, I think the market's going to look both past oil and the consumer because it's really one and the same thing. So I am bullish, and of course there's always the AI trade, which right now shows no sign of easing up. So I'm in agreement the market could move higher, but I do think there's some risks out there, which I just named, which could derail it a little bit, but I don't really see any disaster.
Okay. Shan, what do you think about this market? Do you think people are getting a little too bullish or not really? Because there are a couple of other notes. Ned Davis research today, it's hard to be a bear in this business. History's favored the bulls. I think everybody knows that. But the long-term trend in valuations look extended. The tape's holding up, but we're watching for deterioration. Deutsche Bank asks, does something have to give? Right? Everybody is so glowing about this, what they call a near immaculate scenario where basically everything goes right. Is that a sign of watch out?
Well, I think you mentioned, Weiss just mentioned valuations, and so 2 areas of potential concern are going to be slowing AI CapEx or, an inability to rationalize CapEx, which obviously we haven't seen as part of the results over the last several weeks. Valuations, to Steve's point, actually we've seen PEs compress on stronger earnings, and despite the risk that Steve mentioned, which is real rates have been rising. And I think, Scott, if we were in a different environment where earnings growth was not as strong and as broad, this increase in the long end of the yield curve, not just here in the U.S., but outside of the U.S. as well, would be creating a significantly more consternation in terms of equity investors. But yet, this earnings growth has been the underpinning of this. I do think that there's going to be a bit more dispersion as we come out of this earnings season. There typically is. We're cusping into September. There could be some policy questions. And so I guess it comes down to is your view that the areas of earnings strength that we've had, which is technology, but broader technology.
Gosh,
but also,
at this point, kind of everything now.
But that's what I'm saying.
Just not as glowing as tech, but it's like you can't hate on any part really of the earnings picture. You're doing like 14% average for every sector in the market.
And when you say something like taking out one time, you still have earnings growth of 21%. That is incredible in terms of the breadth that's required. I would say the other thing to look for as we go into the fourth quarter is where you want to be positioned in terms of this idea of compute as an asset class. And NVIDIA brought this up last week with their memorandum of understanding. What does that mean? Does that mean memory? Does that mean networking? Does that mean hardware? And I think that's where you're going to have to be a little bit tactical, a little bit selective in the next 6 weeks or so, because those opportunities plus semis are probably going to be more attractive than what we've seen, for instance, in software in the short term.
Do we think, Jimmy, that this, what Deutsche calls this current equilibrium, do we think that's sustainable?
Yes, but for how long is the question? And I would say certainly through the end of the year. And the equilibrium that I see, and Shannon, I think you were pointing this out, is that the multiple, roughly 21 times next year's earnings on the S&P 500, is very reasonable for the growth rate that we're having in earnings, mid-20s%, even if you strip out the one-timers. The problem, and I'm not going to say the problem, but the thing to consider is that growth rate of mid-20s% is not going to last in perpetuity. That's why I'm not that comfortable going as enthusiastic into 2027. Let me be clear. I am not suggesting selling stocks. That's not my point. My point, though, is that over the last 4 years, including this year's, we've had well into double-digit percentage returns on the S&P 500. And I think that will continue through year end. But I think the bar for growth of earnings becomes much higher in 2027. We're looking at, roughly 14% earnings growth next year. And the slightest disappointment to those numbers could bring the multiple down. Now, let's be clear. We're talking about earnings growth and a market that should be going higher. But I think it's tough to predict a fifth year of double-digit gains. It's only happened once. The late 90s.
Why aren't people talking about, guys, give me the 30-year, please. Why aren't we focused and fixated more on that, the 30-year Treasury, which is now at 5.29? Okay,
So,
Warsh comes out of that Fed meeting, right, and reveals the fact there were 3 dissents. The talk seems to be much more hawkish, even though the action didn't match the rhetoric. Nonetheless, the 30-year yield shoots higher. We continue to have a lot of issuance coming on the market, right? These debt raises from the hyperscalers, among others. The concerns about the deficit and whatever other issues you want to suggest are leading to the fact that the 30-year yield continues to rise. It doesn't matter?
For now, it doesn't matter, but I think you're onto something, Scott. I do. I don't so much think it's the 30-year that matters as it is the 10-year. The 10-year, as I think we all know, has been in a range of 4% on the low end to 5% on the high end for about 3 years. And we do have to wonder if what the 30-year is doing is telling us that the 10-year is going to go higher. And if it goes above 5%, that could be a way of the world saying, listen, we're not going to finance indefinite deficits, whether it's at the federal government level or at the hyperscaler negative free cash flow level. But I want to make this point clear as well, that while it is wise of you, Scott, to bring up that question and for us to discuss it, this is not an action that somebody should take now, at least in my opinion. Somebody should not look at the 30-year at 5.29% and say, well, that's it. I got to get out of all my hyperscalers because higher interest rates are here. What the interest rate environment is reflecting is that there is greater uncertainty with Kevin Warsh, who is speaking much less to the media.
It does, Shan, raise a question of, whether this is an opportunity to increase your exposure in bonds, or if it's too early because you still think that yields are going to back up even further. I hear some people suggest that this is a generational opportunity, potentially, the way that the 30-year has backed up.
Yeah, and curve steepening is not getting the attention I think that it deserves. But I think that the reason why is that for right now, I think the equity markets in particular are looking at real rates rising as an indication of growth. You start to think about that in terms of inflation or valuation stress or that greater issuance, then it starts to look a little bit less tenable. But the overall steepening of the curve gives you as an investor significantly more latitude to add incremental duration, a couple of years, lock in some nice yields, and then potentially benefit if, like we expect, the Fed doesn't hike this year. You're going to see that come in as you get closer to December, and you could have already locked in what have been much more attractive yields than they were at the start of the year.
And especially if the next move is, if the first move of the Warsh Fed is a cut, not a hike. And I don't count a pause as a move. It's more clear to me of either a hike or a cut.
I think we're all puzzled why the equity market and risk assets have not responded to the rise in global yields, not just U.S. yields, because global yields are rising. And I think that the common denominator is the absence of the volatility. There still is not elevated bond market volatility. It's a very gradual, orderly increase. The corporate debt market spreads remain tight, offerings, strong demand for them. So I think at the point where the velocity of the move intensifies, then it becomes troubling. Then it becomes something that you have to worry about. I still think, by the way, if you define 2026 and you say, where does the correction come from? It's not on rising yields. It's not on rising oil. It's any time the momentum factor breaks down. When the momentum factor breaks down, the market rolls over, and the momentum factor, a day like today, you have the S&P equal weight built down, momentum factor's higher, the market's comfortable.
Yeah, I mean, you know
with
what it does when that happens? The market sort of resets and rebuilds, Weiss, right? It's done that on almost every occasion when momentum has rolled over. It's felt a little dicey for a few days, maybe a week, but then it has rebuilt itself. I'm not sure what the MTUM is showing today. The Joe T's at a 52-week high. I saw that this morning when I looked, and that's as representative of this trade as anything else. So is that, obviously, right there. That's one of the reasons why people are feeling pretty good, because there's a lot of stuff going up.
Yeah, I think we have to be careful of saying that past will not be prologue in some cases. Rising rates and a steepening yield curve, rising rates always compress equity multiples because the future growth is not going to be there as it was before rates went up. And to attribute this market, it's always going to be a momentum market, I think is a mistake. To your point, however, and I've been talking about this for years now, is that it's a completely different investing cohort that's driving it. If you take out everything that's in passive money and you take a look at who the investors are, they are used to V-shaped recoveries. So until further notice, the 10-year catch-up trade that we saw post the 2000 bubble bursting, those are things really, they're relics. We're not going to see those again for a long time. So it's going to be V-shaped recovery, which, Scott, to your point, is a reset. So, but I think at this point, as I pointed out in my initial comment, rates are the risk. We don't need Warsh to come out and say raise rates, because he's saying the market's going to do it for me, and that's exactly what's happening. So the market's not completely ignoring it. To Shannon's point, it's largely ignoring it, but that's why we're seeing financials move up, because they've got more of a spread to capture.
The momentum rollover recently, I think you could make the case, was arguably the best thing that's happened to this market in a while. Why? Because it cleaned up positioning. The playing field got a lot cleaner. There was a lot of excess leverage in the system. Not to say that it's all dissipated, but nonetheless, it definitely cleaned up the environment.
100%. And we're looking right now at the momentum factor. It's up 8% on the month. That has been the story. Look, I still believe market structure has changed dramatically. I know Steve would agree with me on that. So with the increase of all these quantitative strategies, the momentum factor, I think, is going to become even more important. But I also believe your point on positioning is a really strong one. And I think it's valuable to understand where we are in positioning, because I think that's a leading indicator where markets ultimately are going to be going. Just as an example, take the Mag 7, okay? Take the Mag 7. Where were we 3 weeks ago? The story was about Alphabet. It was about Apple. I was building a position there, and NVIDIA was kind of asleep. Now NVIDIA has awakened ahead of earnings, and it's on positioning. It's getting in front of earnings. It's building the position on the expectation that this is going to be a remarkable quarter. Positioning so incredibly important right now to understand.
Jimmy, NVIDIA is up 12.5% month to date, to Joe's point about awakening. Tech, by the way, is on a roll. The sector is leading this month, 7.5%, and it's no surprise, I suppose, that even on a relatively ho-hum market day, that the NASDAQ is green. That only seems to make sense. Microsoft's been a nice winner this month, as has Meta. Joe said, NVIDIA reports its earnings in a little more than a week. They reportedly are downsizing their plans for the $250 billion guarantee of the OpenAI data center. That's just a news item that's there today. But this stock's back, and tech is having a nice little move again.
And today it's chips really within tech. We can see what's happening with Micron, with SanDisk. And I think it's very interesting in light of what we're just talking about, how the narrative changes as the price changes. Our friend's got Chris Ferrone. I know you have him on the 3 o'clock show quite often. He has a phrase that narrative follows price, and I think it's very accurate. Because just go back about a month, 5 weeks ago, when the chips were down and the narrative was following the decline in chip prices, that peak spending was here, or at least peak spending was being anticipated by the market. Now that has dissipated as stocks like NVIDIA and Micron recover. And that should be the case, because if you get away from the narrative and just look at what the actual drivers are, there is a ton of spending going on in data center. It shows no letup. Roughly $800 billion for the top 5 hyperscalers this year, going to $1.2 trillion next year. Wall Street Journal today has an interesting article about the off-balance sheet spending that's going on that adds about another $2.5 trillion to that. The point being is, if you look at the fundamentals and forget about the narrative that's following price, you will be enthusiastic about NVIDIA at roughly 20 times earnings going forward, and an earnings growth rate of around 30-35%. I think you can put new money to work in NVIDIA right now.
Well, I think that's exactly what people are doing. People that were anchored to building the position in Amazon, in Apple, in Alphabet, which were the leading
like
Mag
Berkshire?
7 year to date.
Like Berkshire?
Right, like Berkshire. Right now, you're looking at an upcoming earnings report where the revenue growth reaccelerates back into the 90% level. You're looking at margins at 75%. They're going to guide to a $100 billion quarter in Q3. You have to build long position. You can't sit on the sidelines and not have that long position going into the earnings. So I think that's ultimately what's happening. And it's interesting because there's the internal Mag 7 rotation, okay? I said this, NVIDIA is the leading Mag 7 year to date. The next 3 best performers are Alphabet, Amazon, and Apple. Each one of those 3 Mag 7 stocks are down in the month of August. It's an internal rotation. Money going out there, going into NVIDIA.
Is it strange to you, Jim? Let me see Alphabet again, guys.
Yep.
Whatever chart you just put up for me, please just put it back up, because I forgot what that was showing, but I want to see it again. I think it was August or whatever that was. And thank you, by the way. So is it strange to you that we learn of Alphabet, we learn of Berkshire increasing its position in Alphabet, and I think it was August, guys, and the stock not really getting much response. Whereas in the past, you can only assume that if you come out and you say, hey, Warren Buffett and Berkshire Hathaway are increasing their stake by a fairly large amount in Alphabet, the stock looks pretty good.
So there's a lot in what you just asked. Is it Greg Abel, or is it the chairman? Is it Warren who's making these calls? And I think the market doesn't quite know. And if it is Greg Abel, he still has a track record of stock picking to prove. I think that's item number 1.
That's kind of the point I'm making, is that the market has already sort of adjusted to the Buffett premium, if you will, leaving the market.
Okay, that is
right?
So that's actually what I was trying to say, that if it were Greg Abel, it's not going to get the premium that had it been Warren making the selection.
Well, one has to assume that
it
is Mr. Abel at this point.
Fair enough.
That it was Warren Buffett who initiated the position, as I recall, he told Becky, right? But now from this point, it's like,
so if
Abel owns it.
So if there is no Warren premium, there are other cross currents that we need to consider. Yes, a year ago, Gemini was the leader in the large language model. And since then, over the last year, even shorter than that, it has become others. It has become Claude, and it's sometimes OpenAI. So that bloom is a little off the rose. Bear in mind, the stock also is up massively from then. And then, Scott, as you pointed out, I guess it was a week, 2 weeks ago, we have had a diaspora of talent in the artificial intelligence division at Alphabet leaving. And the stock has been heavy since then. I didn't want to believe it. You and I had a conversation that day that it happened, and I thought this was an overreaction. Well, it turns out maybe it's not an overreaction, because the stock has languished since that announcement.
Well, no, I dismissed it as well. You were 100% correct. We could walk through this.
Who was?
You were 100% correct. Wednesday, August 5th, 384, all-time high in the morning. 384, all-time high for Alphabet in the morning. At around 11-something, we get the announcement about the chief scientist leaving Alphabet. The stock falls from 380 below 350. We discussed it on air. I dismissed it. Jimmy, you dismissed it as well. The stock has not been able to rally since.
Now, in its defense, 80% web services growth year over year.
I understand that. Absolutely. We understand the fundamentals.
I think you're overreacting to people leaving, is my view. You know,
Good.
Jim
I want you to be right.
Well, Jim Chanos used to keep a list of all the employees, senior employees that left Tesla, and started keeping that list. I think at about 100, and then maybe earlier. And then look what happened to the stock. So you have to assume, we heard the same thing with Goldman all the time. Oh, so-and-so's leaving, so-and-so's leaving. These companies have deep benches. They're not stupid. You don't know what the real reason is for that person leaving. Was the person pushed out because the people below them were chomping at the bit to move ahead? Did the company believe they
I
weren't
don't know.
on par?
I don't think that Alphabet's AI division or whatever even smaller area is the same thing of talking about a firm the size of Goldman Sachs. I mean, there obviously is
No,
brain
that's true.
drain. There is brain drain concern in that area. And by the way, and we'll get to another story in a second that seems to be going through the same issues. But I'm not sure that's a great comparison.
I'm not belittling the brain drain. Yeah, I'm not belittling the brain drain. Clearly, people are leaving that are accomplished there. What I'm saying is that companies have a way of getting through this, particularly the bigger companies. Take a look. When Johnny Ives left Apple, we thought, oh, the stock is dead. Never gonna create a new great design on its devices. So companies do this over time. It happens. So you should pay attention to it, but you also got to know what's behind it.
Well,
and that we just don't know.
We're following it from the frontier model perspective. Can tell you that because there have been a bunch of stories about the very thing happening with OpenAI as that company prepares to go public in a race with Anthropic. I think everybody knows that narrative at this point. Kate Rooney's been following it from the money standpoint to the talent perspective. And what is the latest take that you have on that issue?
Well, Scott, the talent story is a big one for OpenAI, but Anthropic, there's some new details around its IPO. First, just the backdrop here is both of these companies have filed to go public. They put out their confidential filings. We did report Friday that Anthropic has been holding meetings with bankers and investors. OpenAI is a little less clear on the timeline, but as I mentioned, has also filed. Reuters, though, reporting over the weekend that Anthropic's bankers are now starting to value the AI giant based on future revenue of $190 billion to $200 billion. This is in 2028. And for context, Anthropic's last public revenue run rate was around $47 billion. I have heard from multiple existing investors and sources that $2 trillion is the possible valuation that they are expecting based on some of their math and the recent revenue growth. A lot has to go right, though, Scott, for that momentum to continue, especially at this scale. So Anthropic is also facing pricing pressure now from open source models and from big tech companies, which are increasingly trying to undercut on price as well. And then Ramp out with some new data last week showing that spending on some of Anthropic's premier models, especially Fable, has plateaued in recent weeks. There are also some questions about this entire infrastructure build out, if that could be a headwind. No comment from Anthropic on that run rate number in particular. We did hear from Dario Amodei, the CEO of Anthropic, in a very rare tweet over the weekend. He doesn't spend much time on social media, pushing back on some of the criticism that he has been overly pessimistic about AI. It is a very long thread, though, Scott. We won't read you the whole thing, but he chimed in, and that we don't hear from him often.
No, he does. But I think he picks his spots when he thinks that there are maybe existential issues that need to be discussed. And maybe we're at one of those moments as it relates to, AI itself. We obviously know about political backlash against data centers and the like.
It's interesting, Scott. He talked about Gavin Baker, who's a big SpaceX investor, big venture capital investor, and that seemed to be what prompted this response. But there has been this perception that Dario Amodei, at least in Silicon Valley, that he has been overly pessimistic as he responds to, and that he says in this tweet that some of his negativity has been sort of clipped for social media. It's gone viral, and therefore he has gotten this reputation. One of the things he says that there are fair criticisms of AI in the industry. He says he brings up drug discovery as one, saying we haven't really proven the big upside of AI, and he says that's on us. We need to go out and cure diseases for the broader public to say, oh wait, this is actually really worth it. He talks about some of the distrust in tech overall, and says it sort of tries to share the responsibility a bit, and then points to some of the things he's written where he does say on both sides, yes, it's got this amazing potential, but calls out cybersecurity, calls out some of the real risk that is starting to show up. You know, we talk so much about cyber. He's been early on that.
Yeah, well, I mean, maybe one of the few who is willing to put this out there for broader public debate and consumption. Kate, thank you. That's Kate Rooney. Appreciate that very much. Shan, last word to you this block.
Listen, at the end of the day, lower token prices and open source models are not a problem for adopters of AI. And I think that's why you need to continue to look at demand for compute, demand for hardware. It's a lot less about the LLMs going forward.
All right, coming up, big week for retail. We have bullish analyst activity on one noted name ahead of its earnings. We debate it, and more top calls of the day coming up. All right, welcome back. Let's talk Walmart. Reiterated buy today, 150 is the target at D.A. Davidson. Company reports earnings on Thursday. There's the name. Let's get a little bit wider chart if we could, gang. Please see what the stock's done year to date. If you can show me that, please. You can see 3 months down 12-something% year to date, eked out 3%.
Off what was last quarter a really solid print. It was a good earnings report. I think investors became troubled when management spoke about the effects of inflation. I don't think that language is going away in the support. I think they're going to talk about the effects of inflation once again. I also think valuation got the best of both Walmart and Costco. It reached into the mid-50s. It's pulled back now. Maybe not enough. What would I like to see as an owner of Walmart? I'd like to see them deliver on e-commerce growth somewhere near 30%. I'd like to see them deliver on advertising growth near 40%. That'll make me comfortable that the business is still in good condition. Now, while some will move to the sidelines, we'll maintain positioning, and I think it's a pause that ultimately refreshes. I don't know if you're going to get the refresh that is sustainable beyond this earnings report. I think you maybe get a reflex bounce back up into the mid 120s. Be careful with that because you still have the inflation language lingering and the valuation argument.
Guys, if you can, in the control room, if you can give me a Target versus Walmart year to date. Because it's been a Target story.
Yeah, I mean, Target, what's Target up? 55% so far?
57.
Okay. So it's been
But there's a lot of questions as to whether that bounce back is simply a bounce that's not sustainable. But it had to bounce off a bottom of somewhere. Whereas the outperformance, I think, if you were to look at this from a much longer drawback, would be no comparison. Walmart blowing past Target in terms of share performance.
Yeah.
And now it looks exactly the opposite. I mean, part of it is there was kind of only one way for Target to go.
Right.
But they report earnings this week, too, by the way, on Wednesday.
Yeah,
with TJX, which you own.
I think Target's down 37% in the last 5 years. Walmart's up triple digits. I think it was an idiosyncratic recovery related to Target that maybe the business was not going to implode, which was what the anticipation ultimately was. You mentioned TJX. That has been another really good position for us. You've seen strong revenue growth up at around 7%. And again, the thing to remember with Walmart, with Costco, with TJX, not Target, is market share capture. Market share capture in an environment with higher oil prices and higher inflationary pressures, they have the ability, being big box retailers, to have that scale.
No, Costco hasn't traded well either, by the way.
Well, Costco's
because of the valuation standpoint, right?
Valuation, trading in the same possible way. So I like TJX, I like Ross Stores, I like both of those because of the off-price nature. I think Walmart and Costco long term, I own Costco personally, I think you're fine there. I'm just arguing that in the near term, you have this valuation obstacle in front of you, and you have management which is absolutely going to cite inflationary challenges.
Give me Regeneron, guys, real quick, please. Where's that stock trading
You're
today?
a 52-week high.
So at 810, so Leerink had it before at 641 was their target. They're now coming up to this universe in terms of price acceleration. 824 is their new target. What do you think about that one?
So this is a company that has the ability to really rebuild. If you pull the lens back over the last 5 years, Scott, you're going to see in August of 24, the stock was somewhere around $1,200. The stock fell precipitously. The eye care business ran into some challenges. Offsetting that more recently is the collaboration they have with Sanofi. That's been a positive catalyst. That's kind of restarting the interest in owning this name once again, and the momentum which presented itself 2 quarters ago, and that's the reason why we took ownership of it.
Many of these traditional biopharmaceutical companies that are more pharmaceutical now have had the similar trajectory. So it's true with Amgen, it's true with Vertex. And my point on this is all 3 of those companies are now rallying strongly. They have decent valuations, they've got good pipelines, they've got good science behind them. I think this is a space to be. Vertex is my selection.
And by the way, Regeneron, don't hear Regeneron and think extreme valuation.
No,
this is a
that's my
mid-teens
point.
valuation for this company.
Yeah.
Is that what people normally do?
I think a lot of people, when they think of exposure to biotech, they think of the extreme valuation. But to Jimmy's point, in the case of names like Amgen and Regeneron, that's not the case. It's reasonable valuation.
Frank Holland has a CNBC News update for us. Hey there.
Hey, good afternoon, Scott. Congo's fast-moving Ebola outbreak has killed more than 2,300 people, making it the country's deadliest outbreak on record. The virus is spread across 6 eastern provinces as the World Health Organization warns it's in a phase of intense transmission. Health officials say no approved vaccine or treatment is available, though clinical trials are underway in the hardest-hit areas. Opening statements are underway in Las Vegas in the trial of Dwayne Keefe D. Davis, accused of orchestrating Tupac Shakur's 1996 killing. Prosecutors say Davis organized the shooting as revenge, though they do not accuse him of firing the gun. Davis pleaded not guilty, and he faces life in prison. And Tropical Storm Lala is moving away from Hawaii after lashing the islands with flooding, rain, and damaging winds. Officials say roughly 100 homes were swept from their foundations on the Big Island, with no confirmed deaths and more than 200,000 households without power. Scott, back over to you.
All right, Frank, appreciate that. Thank you. That's Frank Holland. Straight ahead, your ETF Edge with Pippa Stevens. Tell us what's coming up, Pips.
Well, Scott, investors are contending with a slew of mixed market signals. Is that itself a signal to reduce risk, and how? That's when Halftime returns right after this short break. We're back on Halftime Report. I'm Pippa Stevens with your ETF Edge. As earnings season winds down, geopolitics retake center stage. Economic data signals consumer weakness but lower inflation. And the markets are still hitting new highs, but with very little conviction. Is now the time for ETF investors to reduce their risk? Joining me now is Sam Husko. He's the founder of SGH Wealth Management. So, Sam, amid this backdrop, what are you advising your clients do right now?
Yeah. Well, first off, I requested maize and blue M&Ms in the green room, and I got assorted colors. So I'm going to work through this today, but I just want to let you know that. But it doesn't take an archaeologist like yourself to see value and to find opportunities in this market. It's in value and growth. It's in large and small, domestic, international. I've been doing this 22 years. I've never seen a bull market have an acceleration in earnings like we've seen today. And don't listen to Michael Burry. This is not the next 1987 crash. Shout out to my perma bears out there. You make my job easier. I just get to debunk your conspiracy theories. But, you know, within that, the economic softening has been happening. Consumers are, a little tighter, but we would say year over year, retail's up about 5%. And dig deeper, travel is up about 6.2. Even though less people are traveling, it has grown in spending by 17%. And if people needed to flex their budget in a bad market, that's an easy place to cut out budget. In the labor markets, I think it's not taking to account that there's a demographic shift. Age 55 and over since COVID to now has seen a reduction of about 10% in the labor force participation rate. And, so they learn that they can retire. That COVID woke them up that they could retire. And boomers have 100 trillion in retirement assets. It's the most of any generation ever. They were great savers. They got into the markets. And if you're ever on Instagram and you're seeing all these 20-year-olds living a super high lifestyle in New York City, it's because mom and dad are paying for it, which is another backdrop to the markets as well, too, to bring a safety net as well.
All right, well, we are going to continue that conversation over at etfedge.com.cnbc.com. Sam will be joined by Victor Haghani, founder and CIO of Elm Wealth. And Scott, I'll send it back to you.
Okay, Pippa, thank you very much. Pippa Stevens up next. Mike Santoli has his midday word. Senior markets commentator and overtime co-anchor Michael Santoli is here at Post 9 for his midday word. So you get a lot of retail this week, and then, but it's still kind of a air pockety until you get to Nvidia.
It is,
in 8 or 9 days, whenever that is.
Yeah, minutes, Jackson Hole, that stuff is hovering out there. I often think that this is when the market decides if we're just going to keep sort of grinding higher, re-risking, top up the tank on equity exposure, because we have had this nice relief and we're sort of riding the high on the earnings season. I do think I know it's looking gift horse in the mouth, but I do think that there's a chance that earnings are almost too good, and maybe you have a pull forward, and maybe they're overplayed on some level, and maybe the market has decided it's paid the maximum amount it's going to pay for each dollar of earnings. Doesn't mean earnings don't go up and stocks don't go up from here, but it's hard to get away, I think, from the zero-sum dynamics of AI. We had this moment when semis and hyperscalers rallied together because both were in the position to do so. So from here on out, maybe it gets a little trickier, that interplay.
What do you make of the 30-year, the yield?
Yeah.
We talked about that earlier. I think it was 5.29 the last we saw.
Yeah.
And the market just doesn't seem to be making a whole lot of it yet.
No, not yet. I still think that 10s matter a little bit more in terms of pricing. They're still kind of being contained in the ceiling of the range we've been in for a few years. Steepening of the yield curve, look, it means good things in terms of implicit growth expectations, but at some point, real yields going up are supposed to matter for valuations and are supposed to matter for rationing capital in the short term. That's not really happening. It's really a result of all the demands of all this capital. So I think it's fascinating to figure out how it nets out, but right now it's just a curiosity.
Okay, we'll see at 3.
Yeah.
That's Mike Santoli. Speaking of the chips, options action is next. Oliver Rennick is following some big moves in that part of the tech trade today. We'll talk to him next. Let's play some options action. Oliver Rennick is live from the Cboe Global Markets in Chicago, and I'm told you're looking at some ripping chips trade today.
Hey, Scott, we're watching big action in the semiconductor stocks today. First, overall positioning in the SMH ETF is bullish again, with call open interest the highest relative to put since April. But traders should be careful assuming this is a contrarian indicator. We saw very heavy put activity in early June, right before the chips rolled over. Today, traders are piling back into the first half favorites. SanDisk up 40% in a week. Micron up 20%. Those two stocks have traded almost $2.5 billion in options premium so far today, way above their 30-day averages. Flows in the DRAM memory ETF are heavily lopsided towards calls again. 62,000 calls bought versus 24,000 puts. Now, here's the catch that goes against all of this. The single biggest trade on the entire tape today, so big I had to make sure it wasn't a misprint because it went so against this trend, was a purchase of more than 20,000 SMH puts. In the money, 630 strike puts expiring November 20th. A synthetic short, Scott, on the chips worth about $130 million.
Wow. Oliver Rennick, thank you. We'll see him again at 3 o'clock, of course. Joe, Micron, Western Dig, Seagate.
Here we go.
Momentum.
The love affair begins once again. Look, I think one of the catalysts was the CapEx for sure. And we talked about when the Mag 7 reported the derivative effect was going to be in memory and AI data center build out names if the CapEx was there. And I think that's what you have. You also have a market where, look, it's August. It's a quieter market. That doesn't mean that the HFTs and active traders are not participating. They are, and they're gravitating towards where they could find the volatility. And the volatility right now is very isolated, and it's isolated in these names.
Jimmy?
Well, Joe and I own Micron, and free cash flow at Micron next year is going to be about $130 billion. A couple of years ago, it was around $20 billion, and that's what's moving the stock. Once you get past the deleveraging that happened in July into early August, situational awareness, the Kospi, all of that stuff, now we're focused on fundamentals. Tremendous cash flow. They're going to be buying back shares. 6 times earnings. Yeah.
Yeah, I mean, Adam Parker's talked about this stock doubling from here. Weiss?
Yeah, it's finally above where I sold it, Micron. And it does have legs. I didn't think it would be the top where I sold it. But I have no regrets. I put the money elsewhere and I'm doing well. So that's how I look at it.
Okay.
Maybe you should get back in.
He did it his way. No regrets.
Nothing's out of the question, Joe. Nothing's out of the question. I'll look at my Terra Nova momentum factor and make a decision.
I like that.
All right. Regrets?
I guess he's had a few. Yeah, kind of, mashed it up there.
Regrets are justification. You call it what you want.
Jimmy, don't do Sinatra.
We'll do finals next. No, Jimmy doing it's fun.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
All right, 3 o'clock Eastern today on the closing bell. Josh Brown will be with me. Chris Heisey, Mark Okada, Sonali Basak, and Megan Shu. And I hope you'll join me as well. We'll track this market right into the finish. Steve Weiss, what's your final trade?
Cisco, I bought it last week, and I like the setup right here, right now. I think it's going to move higher.
Wow. All right. Jimmy, you have that?
I do. I like Cisco here. I applauded Steve for that last week.
Yeah.
I do. Very much so. Bought it on the dip. It had a post-earnings breakdown. He bought it, picked it up on the cheap. Good job. Cheniere Energy, for me, I'm violating Josh Brown's rule of never having a final trade that's in the red. But dips are to be bought in this name.
Okay. And then the IDU, which is red today, is who?
Utilities. That's me. Broad data center growth, Scott, and self-funding balance sheets in the utility sector. So get excited.
No chance that's going to be me.
All right,
I'll take Merck.
How about Merck? Why?
I have Merck breaking out above its June 2024 high. I think this is a $150 stock.
All right, great stuff. I'll see everybody for the closing bell. The exchange begins right now.
Thank you very much, Scott. We start a new week with the memory and chip names breaking out again, although not enough to lift the broader averages. I'm Kelly Evans, and welcome to The Exchange. Who needs a roller coaster ride this summer? Just look at the moves we've seen in the memory space. Shares of SanDisk dropped nearly 60% in a month from late June to late July and have since risen 77%. And the rebound in the memory and chip names comes even as bond yields have been drifting higher. 471 on the 10-year today as we crossed above 40 trillion on the national debt for the first time last night. We'll talk about that. Plus, the foldable iPhone continues. That debate, will it be a huge product, won't it? We talked to the analyst who thinks it will give Apple a huge boost, with the shares now up 11% year to date. And Katie Stockton on why this breakout in small caps is a very big deal. But let's begin with these wild swings in the AI supply chain. Bahan Janjigian is the Chief Investment Officer at Greenwich Wealth Management. Bahan, it's great to see you. And listen, this is important for a couple of reasons. Number one, it's the leadership area, so it feels like it has implications for the rest of the market. Number two, because we've had so many of these rotations where the S&P 500 kind of continues to march higher, today notwithstanding.
Yeah, hi, Kelly. Thanks for having me on. Yeah, you're right. So the AI trade, I think, for a large part, has been going on for a while. We often see stocks selling off and then coming back again. I think this is a signal that it's really time to start thinking about some other parts of the market. The market indexes are doing pretty well. They're near all-time highs, and of course, they had been driven by these AI stocks in large part earlier. But we're seeing the rest of the market catching up, and I think you're seeing value outperforming growth. You're seeing small cap outperforming large cap. So the indexes are doing well despite all of the volatility in these technology stocks. But I think it makes sense for this rotation to continue and people to pick up some of the value names.
Rattle those off, Vahan. What does the Greenwich Wealth Management portfolio look like these days?
Well, I mean, some of the ones that I like a lot in the value area, three stocks that I like very much right now are I like Pfizer, I like Smucker, and I like Verizon. These stocks pay, very generous dividends. Those dividends have been increasing, every single year for a very long period of time. I think in Smucker's case, it's almost 3 decades. And the yield is very high. I don't have any fear about the dividends being cut. The stocks are making good money. They're selling at incredibly low forward PEs, and they're outperforming many of these technology stocks year to date.
What about the Mag 7? This is an area where, the valuations, you could say, look fine. I mean, they're value stocks practically. Shouldn't they be in your portfolio?
Yes, of course they should be in your portfolio. They should be a core part of your portfolio. But remember, a portfolio needs to have more than just one sector or one kind of stock or something like that. It needs to be well diversified for long-term investors. I mean, I don't want to play the game where I'm constantly rotating from one sector to another, but I do occasionally rebalance. And because many of these tech stocks have done very well, I have trimmed. Like, for example, SMH is a pretty big holding in my clients' portfolios. It's an ETF in the semiconductor area with the largest holding in NVIDIA. It's done so well, and I keep trimming and trimming and trimming, yet it remains a core holding.
Oh, wow. So we talked about kind of the Mag 7 broadly. You said like there should be a spot there. And we think of you always as kind of a Buffett acolyte, a Berkshire watcher. So the next question is in both of those veins. Berkshire's adding $17 billion to its Alphabet stake, or it did already. Alphabet, we also learned, has more than 7% of shares outstanding of SpaceX. So what do you think broadly about their moves? They've done a lot with the equities portfolio now, and this is an area, Alphabet, where they see one of their biggest holdings at this point. Do you have a take on that?
Yeah, a decade or two ago, it would have been almost unimaginable that Warren Buffett would have bought something like Alphabet, and of course, they are big holders of that stock. I think it makes sense. I don't think Alphabet is an overvalued tech stock. I think it should be a core holding in the portfolio. I also like Microsoft. That's the tech stock that I've been adding most recently. When we had a big sell-off in Microsoft, I took advantage to add to that stock. SpaceX is an interesting question. I avoided that stock when the IPO came out, but I have to admit, in some of my clients' portfolios, I have some clients who are willing to be a little bit more aggressive and take some risk. I started adding SpaceX when it got below 120. So, so far that's holding up pretty well. I do believe that on traditional methodologies, it's a tremendously overvalued stock. But that's the kind of stock where valuation makes no difference. It's really driven by sentiment, and that stock could do quite well over the next year or two, despite the fact that it seems very overvalued by traditional metrics.
Yeah, and your deep sigh captures your conflicted feelings about it. But by the way, for those who can't see it on their screens, it's at 148 today, up about 6%. What are your thoughts on Berkshire more broadly amidst the leadership transition here?
Oh, I think Berkshire is a great company. I'm not concerned about leadership transition. I think the company will do well. I think Greg Gable will be a very good CEO. Of course, as everybody knows, they have a tremendous amount of cash that they're able to put to work when they see great value. So yeah, I like Berkshire. It's not a major holding in my portfolios. And keep in mind that Berkshire, if anything, is like a very large mutual fund. Not only do they have a huge portfolio of publicly traded stocks, they also have a very large portfolio of private companies. So you can get quite a bit of diversification just by owning that one stock.
Yeah, it's a good point. Although comparing something to a mutual fund doesn't really get the blood flow. I take your point. Two quick final questions. Both are kind of lingering, looming issues, are sort of related as well. $40 trillion on the national debt. What does the typical, 471 on the 10-year? What does the typical investor have to think about when we hear those figures?
We've been talking about the size of the national debt for such a long time, and it seems to make no difference. Interest rates have remained relatively low, but I do expect interest rates to continue rising. And of course, the higher interest rates go, the more expensive it becomes to service all that debt. Interest payments on the debt are a huge portion of the budget right now, and I expect that to continue growing. Now, from an investor's perspective, there's always a competition between stocks and bonds, and I believe that if you see the 10-year somewhere around 5%, it becomes a little bit too appealing to ignore. So I would be buying the 10-year pretty aggressively if we get up to about 5%. I have been buying more bonds. I've actually bought some 20-year bonds, and I've also recently bought some 2-year bonds. I mean, I think the yields are pretty good, and I'm willing to take that with little to no risk.
I guess I would just say as a coda to that, I'm very relieved that as long as people will take it at 5%, I guess we don't have to. I don't know what we do about the growing debt and the $1.2 trillion in interest costs, but at the end of the day, it'd be a much bigger problem if it gets to 5% and people start balking at that, thinking they can't own it because 6% could be the next stop or whatever.
Well, that's right. But also, let me point out that starting around 2008, when we had the financial crisis, the Fed drove interest rates down to zero, and that really helped the equity markets, especially growth stocks, and it really punished savers. Older people like me, for example, who like to keep some money in the bank, they got really punished. But now a lot of that is changing. Interest rates are returning to more normal levels, and I think that's another reason why you could see value stocks outperforming growth stocks, because at higher interest rates, stocks that have cash flows that occur sooner rather than later become more attractive.
And that's why I note that we do have the snapback in some of the memory and chip names, even with the rates up today. I was going to ask you about Iran. We're kind of out of time. I don't know if there's any final comment you'd make there.
Iran is a big question. I guess I would say the biggest surprise to me is that oil prices have not gone higher than they have. It is pretty incredible that we've been able to get as much oil out of the Middle East as we have. I do expect to see more pipelines built and things like that, but I'm very concerned about the depleting levels of the SPR, and I think that's going to be a major concern. So I do expect oil prices to go higher.
Yeah. All right. But if so, we just kind of take it for what it's worth. Is there anything to do about that, or?
As far as oil prices go, or as far as the Iran war goes?
People are talking about energy stocks breaking out. I mean, things like that. And I don't know if you want to bet on that and have to then require.
Well, I have been betting on that. I was a buyer of energy when energy was out of favor, and it became a significant portion of my portfolio. More recently, though, I've been trimming. Again, it's a sector that's done extremely well. I believe it's the best performing sector year to date. So I've been taking profits in energy, but I'm not going to sell it all because, as I said, I do expect prices to go higher.
All right, Vahan, thanks very much. Really appreciate all your thoughts today.
Thank you, Kelly.
Good to check in with you, Vahan Janjigian of Greenwich Wealth Management. Meantime, speculation is rife over Apple's new foldable iPhone. Our next guest says the company will get a big boost from its expected launch next month. Let's bring in Rothschild & Co. Redburn's head of technology, hardware, and semi-research, Tim Schultz-Melander. Tim, it's great to have you here. Welcome.
Hey, thank you for having me, Kelly.
A lot of people excited about your note today. What can you tell us about the foldable iPhone?
So we have a pretty positive take, as you've just mentioned. We've looked at Apple's track record of entering new markets. It's one that we're very impressed by, both in terms of the market share impacts that they have, as well as the way in which Apple's entry frequently accelerates the growth and the size of such markets. It's a surprise to us that Apple hasn't been in the foldable segment before. It's an ultra premium segment. Prices tend to be somewhere in the region of 80% above even high-end handsets. And so for us, this is a really neat, basically kind of match made in heaven for Apple. The brand, the styling, design, and the consumer positioning all suggest to us that a foldable phone, the iPhone Ultra, which we expect to launch next month, is going to be a successful product for them.
So, listen, I'm just going to say this as this is my gut reaction when I see photos of this foldable iPhone all over the internet. I don't know whether to trust them or not. I don't love it. I'm just going to be honest. I think it's a little, the crease, it just seems clunky. It doesn't seem like the elegant, sophisticated consumer product that I've covered. And I know other handset makers have them, but I don't like them either. So will I look back on this and laugh a year from now when I'm holding one of these shiny new products?
You know what, Kelly, it's horses for courses. So foldable phones are really big in certain markets and really not big in others. So in China, for example, a very important market that we expect for the handset, there are consumer pockets in the US and in developed markets that are strong foldable product, foldable markets for the iPhone Ultra. And there are others where the product just doesn't land. And maybe you're one of them. I will say, when we look at the specs that we expect, to your point, the liquid metal hinge, the work that they're doing on the display, we expect this to be a very strong contender. Is it going to convert everybody on day one? Maybe not. I think let's see where the temperature is after 6 or 9 months. In our forecast, we think we're sitting on this already pretty conservatively. The ASP, the volume uplift, and the new market entry that is, we expect, not going to cannibalize in a meaningful way the Slate, tab form factor iPhone sales. To us, is Apple stepping into a new market, which is really going to help them also defray rising input costs into that Apple iPhone business.
No, to you guys, this is a very big deal. If I'm correct here, you've gone from a neutral on the stock with a 260 price target to a buy in a 400. So this is, for you, a pretty big deal. And, so talk through kind of even how this flows through the balance sheet and the kinds of numbers that you see flowing from this. How much adoption is needed for your price target to come to fruition?
Right. So our report today really sets out 2 big elements to our investment thesis. So we've just talked about the first, the iPhone foldable, the iPhone Ultra, how that's going to enhance the iPhone franchise. It's a broader, thesis than just that. We also like the way in which Apple is starting to segment its new product launches. So the iPhone 18 Pro Max is going to be a much more concentrated launch versus what we've had historically. That's going to allow them really to basically price for the absolute highest end consumer, which we expect to be positive for mix. So that's one part of it. The other part that we talk about in today is we really like the way that they're starting to fix some of the issues that they see in Apple services. This is a company that's had a big pivot in AI. We see that as a first step, and we really like some of the innovations that are going to be coming through from September to year end here.
So talk about the neutral, why you were more cautious on the stock, and a couple of things, not just the foldable launch, but John Ternus taking over as CEO, big deal, biggest transition, obviously, for the company, and however it was that period for Tim was 15 years time or so. And then AI, where they've benefited by not having this massive CapEx spend on it. You also think they might benefit from a closer collaboration with NVIDIA going forward. Is that right?
Yeah, we think that's a possibility that investors and that the companies should explore. I think if we turn our mind back to the last couple of years, I think investors correctly questioned what AI as a big thematic platform change, what that would do to Apple. If this is going to change the way people access and interface with information, then it had the risk that it was going to disintermediate Apple and its position as kind of the client gateway or the customer gateway to things like search, and that's what underlies the big payment that Google makes to Apple every year. So AI as a platform change was a threat, and that's been an area where Apple Intelligence, Siri AI have been not hitting the high notes, have been kind of disappointing over the last couple of years, and that was a part of the reason why we were more cautious. Coming into this year, as you say, Apple has not played in that CapEx kind of space race. It's not spending hundreds of billions of dollars trying to build a frontier model. It's chosen a different path. We think one that now, with improving open source models, actually has a broadening of strategic options.
True.
And one of them that we think about is maybe, could they be working more closely with NVIDIA, where historically that relationship's been somewhat fraught?
Yeah, no, it's a great. And by the way, here's my biggest issue is I shouldn't even say Siri, because when I say it, I have to wait for her to go bing, the latency, it feels like it's 3 seconds, and then I want to just say, hey, Siri, call so-and-so. But then she's like, yes, but I've already said it. And then I have to say, it's like being on a conference call where the one, I don't know how you fix that, because I don't want her listening all the time.
Yeah, so look, yeah, there's room for improvement. And I think one thing we know about with Apple, this is a company, when they set their sights on something, they're pretty maniacal and extremely methodical about how they go and improve that customer experience. So I think let's watch this space. Let's see how they do in the second half of the year.
I'd like to find a way to use horses for courses again before the end of the hour. That's my personal challenge. Tim, thanks so much. It's been great talking with you. Thanks for the time today.
Thank you, Kelly.
Tim Schultz-Millander from Rothschild at Redburn. Coming up, it's a big week of retail earnings, with Home Depot kicking things off tomorrow, followed by Target, Lowe's, TJX on Wednesday, and Walmart on Thursday. Consumer discretionary, I should say, is the only sector still in the red this year. Plus, China gaining some ground in the AI race. Alibaba's open-weight AI models are surpassing Google's and Meta's to become #1 in global downloads. We'll ask CraneShares CIO Brendan Ahern what it means for Chinese tech stocks when we come back on The Exchange. Stay with us.
This is The Exchange on CNBC.
We are diving headfirst into retail earnings season this week, a period where we often see big divergence between the winners and those who are falling behind, at least for the moment. The first to square off this week are the home improvement stocks. Home Depot tomorrow morning, Lowe's is out Wednesday. The market already betting on Home Depot this quarter. It's up 13.5%, while Lowe's is lower. Simeon Gutman is managing director and senior retail analyst at Morgan Stanley. We turn to you, Simeon, for some deep, penetrating insights that can come from retail earnings season. So where would you start us?
Well, let's start at home improvement. I think that's a good start. This is a sector that has been normalizing in demand for the last, call it 4 years. And we're waiting for eternity to turn. We're waiting for demand to re-stimulate. And we're starting to see signs. Demand's probably bottomed. And the way retail analysts look at multi-year stacks, where we add the comps together over the last years, you're starting to see a bottoming and a slight inflection. I don't think people are running around buying homes a lot. We know the numbers, but we're starting to see normalization of demand, the passage of time, the depreciation of homes. People are starting to do a little bit. So we're starting to see some activity pick up.
Is there even kind of a broad comment to make about Lowe's, Home Depot? I mean, is the market reading this correctly, that one's executing better than the other?
Well, Home Depot has made more aggressive and assertive bets in the wholesale distribution channel. Both are making newer bets there. So the premise is, if and when a cycle turns, Home Depot's slope will be a little bit steeper, a little bit more dramatic, whereas Lowe's probably a little less so. Those are the two distinctions the market's making. We believe that's the case as well. The exposure they have to some of the end markets should give them a little bit of a faster revenue growth when we turn.
All right, so then we move on from there. We get into the bread and butter, which is Walmart. Are they going to, the messages from the consumer side, this is my opinion, have been fairly strong in recent months amid the oil price spike. I'm talking about the monthly data. Yes, the retail sales report on Friday was a little bit softer. I don't know if there were some one-offs in there. What do you think Walmart's likely to say?
So first, I agree with you. The data has been good. If you look at the high-level data, the consumer's great. Some of the wobble that you saw in July was probably because of the sales pull forward, Prime Day, and every retailer had their own version of Prime Day. So Walmart, Target, Costco, they all participated. They had to. So that pulled some sales into June, took some away from July. Walmart looks fine, looks healthy, somewhere in the mid-3s. That's a lot of dollars, by the way.
Right.
If you add back some of the pharmacy impacts that they're encountering, they're probably north of 4.
Okay.
It's good. Oh, go ahead.
Tell me about that. We spoke with another analyst who brought up this pharmacy problem that they've been having that could weigh on the results this quarter. Could you explain that?
Not a problem per se, but it's a reimbursement issue. So year over year, they're getting less money back for GLP-1. There was some mandate. There is a volume that's increasing, so they're actually selling more scripts. It's just the rate at which they're getting paid back is getting a little less. So it's an optical headwind, not a problem from a unit perspective. So the underlying 4, call it, is quite healthy and fine. But, and this is the but I was going to highlight, the spread between Walmart and the rest of retail is probably narrowing a little bit this quarter. And that's what the market is trying to decipher. And we look at it as, look, Walmart is a heavily grocery-oriented retailer. That mix is not that elastic in general. And if the consumer, as you mentioned, is strong and pushing more in discretionary, that favors other retailers that have slightly more discretionary mix in that quarter. That's the dynamic that I think we're seeing in the second quarter.
Final question. Everyone's excited about Target, although I remain somewhat skeptical myself. I don't know. Maybe I'm just getting old. But it's up 50-some% this year. So you do have to say, okay, they've had the new CEO in place, I believe, since earlier in the year, maybe February. You've been more positive on the stock the last couple of years. So are you expecting more to come in terms of the stock performance?
So I think the rubber will meet the road in the second half of this year. We did upgrade it a year and a half ago. You want to own a discretionary retailer that has apparel and home exposure when they're moving quicker in those areas than they had been before. So this is their moment. I think the equities performance to date has been the optimism ahead of that. Right now, in stores, we could start to see the beginning of the new merchandising changes. They've done some. But a lot of the big lifting we think is going to be in the back half of the year, which means the stock is just beginning, meaning the setup begins now as opposed to what's happened so far. It had been an underperformer for the last 5 years. If you show the chart, if you can, between Walmart, Costco, and Target, you'll see. So this is the hope that the next cycle works. But we think that happens now going forward, and that's the merchandising changes we're going to need to pay attention to.
All right. Well, you're making me think twice. I mean, and those we were just showing the PEs at 17 times for Target, 38 for Walmart. So yes, if they start to earn that as well on top of the momentum that may be coming, that could be pretty compelling. We'll leave it there for now. Simeon, thanks very much. Really appreciate it.
Yeah.
Simeon
Thanks,
Gutman
Kelly.
joining us, Morgan Stanley, to kind of lay out the week we might be seeing. Speaking of retail, check out the footwear stocks stumbling again today. Nike, the biggest laggard in the Dow. Well, it's still in the Dow. Let's just put it that way. It's down 4%. Worst day since June. Lowest level in 12 years. I just mentioned this. Similarly, underperforming stocks often get kicked or booted out of the Dow. We'll see what happens there. It's been a rough month for the whole group. JP Morgan turning bearish on Nike a couple of weeks ago, saying that turnaround plan is taking longer than expected. Meanwhile, On, coming off its worst day on record last week, the maker of On footwear, plunged 20% after tempering its sales outlook for the year. And Under Armour recently lowered its full-year revenue guidance, leading Barclays to downgrade it to underweight, citing a delayed brand recovery, competitive sector, and what they call macro-related consumer malaise. Maybe it's Aloe, and that's a tease for Power Lunch next hour. Stay tuned. Coming up, highlights from a rare and exclusive interview with OpenAI President Greg Brockman. He responds to the company's recent string of high-profile departures. We'll wrap up his remarks after this. Welcome back. President Trump is threatening to bomb Oman if it, quote, gets in the way of U.S. peace talks with Iran as the ceasefire expires today. At the same time, he's reducing joint military exercises with a key ally. Eamon Javers is in Washington with the latest. And to tell us how these stories are related, if they are, Eamon.
Yeah, Kelly, that's right. President Trump on Fox News this morning threatened to bomb the S out of Oman if that country, as you say, gets in the way of U.S. efforts to reopen the Strait of Hormuz. Omani negotiators have been in conversations with Iran about a new regulatory regime for the crucial strait, an agreement that reportedly could include fees or tolls for international shipping. Now, in response to the president's comments, a senior Middle Eastern diplomat with direct knowledge of the talks told MS Now's Ian Sherwood this morning Oman is focused on working toward a solution that leads to the reopening of the Strait of Hormuz. It's their primary objective. Of course, that comment doesn't really respond to the president's threat or indicate if the Omanis are likely to back off an emerging agreement with Iran. All of this coming as the United States and Iran officially hit the end of that 60-day period that was originally set up for peace negotiations. Those talks have long since broken down. Meanwhile, former Congresswoman Marjorie Taylor Greene taking to social media today with an incendiary claim saying without evidence that the White House is, quote, discussing using nuclear weapons on Iran in strategy meetings. But a White House official pushed back on that claim, telling CNBC in a statement this afternoon, quote, Marjorie Quitter Greene has no idea what she's talking about. The former Congresswoman disgracefully quit on her constituents during the middle of her term and wants to pretend like she has insight into the president's thinking. She is completely out of the loop and should quit spreading fake news. And Kelly, that other story that you mentioned, the president pivoting away from South Korea, saying that he's frustrated with South Korea's lack of response to his request for help in Iran. He says he's now going to downsize U.S. military trainings with South Korea in response to that. So that's how you're seeing this Iran war sort of morph into concerns throughout Asia about U.S. strategic posture.
Some questioned whether we were doing less with South Korea because we've run out of munitions. I would also add, by the way, these reports about how I believe in Romania, they were shooting down Russian drones out of the sky, increasing anxiety about the repeated incursions we're seeing from Russia and to some extent Ukraine as that war continues over European airspace, and whether that would again be an area where NATO and the U.S. have to step up potentially and do something.
Yeah, there have been repeated warnings that have shown up in the media from intelligence sources suggesting that there is some kind of chatter to the effect that the Russians do want to make an incursion against sort of NATO's easternmost flank in Europe at some point in the next year or so. And you know, it's all about getting in Vladimir Putin's head. What does he want as an endgame to Ukraine? Does he want to sort of sue for peace and see if he can sit the battle line where it is? Or does he want to escalate into NATO and try to achieve a victory somewhere else to make this whole operation more palatable for his domestic political climate, given the enormous losses that Russia has sustained so far in Ukraine? You could see where he would feel he needs to achieve something militarily to justify it. But an incursion into NATO, obviously the stakes are enormous with that.
Yeah.
And the implications would be enormous as well.
All right, Eamon, for now, thanks very much. Really appreciate it.
You bet.
Eamon Jefferson, Washington. Let's get over to Frank Holland now for the CNBC News Update. Hi, Frank.
Hey there, Kelly. Chinese President Xi Jinping will skip next month's UN General Assembly in New York, opting instead for a shorter trip, a one-day trip to D.C. to meet with President Trump. That's according to Politico, citing 4 people familiar with Xi's itinerary. Xi's U.S. visit comes after Trump's May trip to Beijing and some new strains in their relationship and the relationship between the two countries after Trump accused China of election interference in a July Oval Office speech. Newly approved Attorney General Todd Blanche today launched a new process allowing some people with felony convictions to apply to regain their gun rights. More than 300,000 people are expected to apply during the first year of this initiative, and the Department of Justice says requests will be reviewed case by case, while violent felons and registered sex offenders will generally remain ineligible. And ESPN reports NBA investigators found no evidence Clippers owner Steve Ballmer funneled money through team sponsors to pay Kawhi Leonard and evade the salary cap. The probe centered on Leonard's $28 million endorsement deal with bankrupt Aspiration, where Ballmer invested. The Clippers have denied wrongdoing throughout that investigation. Kelly, back over to you.
All right, Frank, thank you very much. Coming up, Meta CEO Mark Zuckerberg stole last week's spotlight with his manifesto on open weight models. Now Alibaba is answering with its latest model and seemingly giving China a boost in the AI race with America. We have details and fallout for tech stocks from here to Shanghai right after the break. Stay with us. Welcome back. The KWEB Chinese Internet ETF used to be one of the hottest trades in town in the late 2010s. Components like Alibaba were often some of the biggest, most exciting bets on Wall Street, owned by the likes of David Tepper and Stan Druckenmiller. That all came crashing down in late 2020 when Chinese regulators clamped down hard, suspending the IPO of Alibaba's fintech arm Ant Group and beginning a broader crackdown of the tech industry. Since then, Chinese tech stocks and Chinese stocks more broadly have basically gone nowhere. The Chinese economy, same story. All of that said, Alibaba is back in the limelight lately as its new AI models reportedly hitting 3 billion downloads in the past 6 months, more than Google or Meta. So should investors rethink their aversion to Chinese stocks? Let's bring in Brendan Ahern. He is the Chief Investment Officer at Crane Shares. It's great to have you here. Thank you so much for coming in.
No, thank you for the opportunity, Kelly.
So it has been a tough slog for investors. And there's been a series of kind of, maybe we're on the cusp of another breakout. Maybe, it reminds me of the small caps a little bit.
Yeah.
What would you say about the posture that you think China is now taking towards AI innovation? We've seen some IPO activity lately, its attitude towards Alibaba.
Yeah, I mean, certainly the last 4 years have been a little tough. You're a great makeup crew. You can't see my wrinkles from all the frustrating, but I think you're seeing really a troughing that we've been through a really tough cycle, but you're clearly seeing some innovation coming out of China. I think there is an AI picks and shovel trade where Korea and Taiwan get a lot of attention, but in onshore China, like say in K-Star is our Starboard ETF, really strong performance. That's where a lot of the semiconductor names, but obviously Alibaba, Tencent, these are the names investors are really looking at. And I think as we head into Alibaba's earnings on Thursday, there's some optimism about AI.
So compare this a little bit. You know, back here we've been talking a lot about the Mag 7 versus the chip and memory names. Sounds like there's a little bit of a similar give and take going on there with the different ways that you could kind of segment down the industry.
Yeah, 100%. I think for Alibaba, similar to what you saw from, say, Alphabet, it's going to be about the cloud. How much is that cloud growth? We think about almost 20% of revenues for this quarter will come from cloud, be about 40% growth year over year. So I think these are really strong numbers. Obviously, domestic consumption in China, a little bit of a struggle still. Hopefully we'll get some stimulus potentially in September.
So let's say I looked at this and said, okay, Alibaba's got a successful model, bunch of downloads, it has the cloud business. It's kind of like Google, but cheaper. I imagine its PE is lower. But let's go back now to what happened with the tech clampdown, which all kind of started after Jack Ma had given this speech about how, you know, China, everything needs to be better and they're holding us back. And they said, oh, really? Watch us. We've talked in recent years about how they've started to back off a little bit. I don't know how you would characterize the industry. So when we see these headlines now, when people look at the stocks now, do you think these stocks can truly thrive and throw the shackles off? What's the environment like?
I think for foreign investors, money will flow where it's treated best. And arguably, you had some real challenges in China. I think you've seen this 180 because the Chinese government understands they actually need these tech entrepreneurs like a Jack Ma, like a Pony Ma at Tencent. And so you've had this total pivot in sentiment. Now you're seeing policy support. You're seeing technology self-reliance is a big theme in China. And lo and behold, here's Alibaba with a very, very competitive, their Qwen AI large language model, leveraging their cloud computing.
A couple of various questions. I'd love to know who else you're keeping an eye on in the space, either in the suppliers or in some of the kind of big names. And would you describe all of this then as how much of a threat or opportunity for the U.S. AI industry, if we could call it that? You know, there's a lot of people who use the Chinese open source models when they can't find a U.S. alternative. So are we frenemies? I mean, how do you think about it?
Yeah, I think corporations, a lot of data sensitivity, they're going to use that enterprise model from an Anthropic, like an OpenAI. At the same time, for small business owners, for a lot of our daily use, why you just can't necessarily afford those premium services. And so China's going to fill a little bit of that void. I think the key is in China, the AI revenue model is linked to the cloud. And that's where Alibaba, Tencent, as well as Baidu reports tomorrow. They've got a growing cloud business. Actually, Duquesne, Stanley Druckenmiller, just filed. It's only 88,000 shares he filed of owning Baidu, but a little bit of some hope there for Baidu, which has really, really suffered a little bit.
Who else would you be keeping an eye on?
just in terms of the individual stocks.
And I even think about a CXMT. This was the big Chinese memory name that's come on.
Well, Wednesday we have Unitree's IPO. So this is the global leader in terms of humanoid robots. They're going to be, they're about $9 billion in market cap. This is a company, they're profitable. They're first half of this year, they did $169 million of revenue, $40 million of profit. So they're making money. That's up from $250 for all of last year, 2023. They made $23 million. So in 3 years, they're going from $23 million to $169 in the first half. So this is a really important company to watch, global leader.
And finally, is it just a coincidence they're all reporting this week? Is this kind of Chinese tech earnings season, or?
Yeah, where everyone else is at the beach other than you and I, Kelly. This is our prime time. This is our go season where we've got all of the earnings, a lot of IPOs as well.
And CXMT was one of those recent IPOs, was it not?
Yeah, and CXMT listed on this science and technology, this STAR board. We actually went and bought it in our K-Star ETF. So really the most valuable company in China today is CXMT. One of their main peers in the high bandwidth memory, YMTC, Yangtze Memory, is going to be going public. We don't have the exact date, but also on this STAR board. That's another leader competing with SK Hynix, Samsung.
And finally, then, just to kind of put a pin in it, as you said, I'm thinking, okay, so if here I am, I'm harping on KWeb, but that would almost be like harping on the Mag 7 for kind of flattish performance. Whereas for you, K-Star and some of these other areas, I mean, although the Chinese market itself has not been as anywhere as strong a performer as America's, but it does matter which slice you're looking at.
100%. This is like the K-Star is more like the NVIDIA, where KWeb is a little bit more like the Mag 7. And that's where you see this yin and yang, where I think particularly the names in China, trade investors are very keen to this AI supply chain, picks and shovels trade.
All righty, team. I am back.
Big week.
Please excuse the messed up screen. My assistant was not doing her job. I do apologize for that. Today has been a day full of nothingness, a nothing burger. We finally did get that move to the 775 down to the 773, but I was not here, unfortunately. But I did call it out, so for those of you who were able to take advantage of that trade that I called out, make sure you hit me with a little sandwich on the Cash App. Make sure you hit me with a little sandwich on the Cash App. That's right, I called out that 776 put, getting in at 775, taking it all the way down to 773.4. Once again, going to the bank. Another beautiful call. However, I stepped out and I missed it, unfortunately. But I called it out so that the team could profit from it. So shout out to the team. And thank you, those of you who's going to hit me with a chat. One of those little, what are they called? Super chats. Yes, sir. Super chats jumping off. Don't be shy. All righty. What are we going to do now? Again, I only called out that 7734 because it is here. We anticipated the market bouncing, and that is exactly what she is doing now. Which is why, if you look at my plans, I do not have a second profit target picked. At 7734 was my selected profit target, and that was the end of the ride. I do wish I would have been here, but I wasn't. What can I do? It went down at 12:30. The move happened at 12:30. Here on the 15-minute chart, you can finally see the breakdown. We got that close below the 775 area. The next candle is your continuation candle right on down to the next level of 7734. Beautiful trade. Damn, wish I'd have been here. Quiet souls in the building. Dr. JB's in the building. Shout out to both of you gentlemen. I don't know what it's going to do now. Anybody have any ideas of what it might do now? I have no idea what it might do now. Have a little chicken salad or something, some crackers.
Chicken salad, wrapped chicken salad.
All right.
You want some of that Chinese?
Yeah, give me some of that Chinese food or something.
Welcome back. OpenAI has seen a slew of executive departures this year, including 2 just last week. But President Greg Brockman was on Squawk Box today, and he brushed off concerns, saying if OpenAI wasn't in the spotlight, no one would be batting an eye. Kate Rooney has more in today's Tech Check. Hi, Kate.
Hi, Kelly. Well, they certainly are in the spotlight. OpenAI co-founder and president played down some of the criticism about a string of executive departures lately. Most recently, it was Chief Revenue Officer Denise Dresser, who announced last week she was stepping down. Here's what Greg Brockman told Andrew on Squawk Box.
I'm a constant, Sam is a constant. I actually think that the difference between OpenAI and other organizations is that we are so much in the spotlight, so every departure gets scrutinized in a way that it doesn't otherwise.
Kelly, Denise Dresser, who I mentioned, is part of about half a dozen high-profile exits that we've seen in just the past 6 months or so. The focus of that interview was really on cybersecurity, though. He says human written code is full of vulnerabilities. He called out what he described as tech debt, and cyber overall has been one of the biggest topics in AI after a string of hacking issues with OpenAI and others. Kelly, over the weekend, we also got a very rare Dario Amodei, who's the CEO of Anthropic, citing on social media. He responded to some recent criticism that he has been overly pessimistic about this technology. He argues he has been equally balanced between some of the risks and the benefits. Finally, Kelly, speaking of Anthropic, I did just speak to a source as well. Anthropic, over the weekend, I'm told, shared a second quarter financial update with existing investors. Revenue there grew about 14x year over year, topped $11 billion in the second quarter. That is a preliminary estimate. But based on some of these numbers, multiple sources that I've talked to, Kelly, say they are now forecasting a possible $2 trillion valuation when it comes to that IPO.
All right. Nothing to see here. He says, move along. Everything's fine.
Exactly.
Kate, thank you very much. Kate Rooney. Speaking of OpenAI, their new data center in Ohio is being built by SB Energy, whose CEO will also join Squawk Box tomorrow morning around 8:40 a.m. Eastern Time. Coming up, the iShares small cap ETF, the IWM, down about 0.5% today after closing at an all-time high on Friday. And technician Katie Stockton says there's more room to run. We'll check the charts next. On Friday, we highlighted the breakout performance of the small cap Russell 2000, which hit an all-time high even as the other indexes declined, capping a remarkable 23% surge year to date. The small caps have outpaced the S&P and NASDAQ by a whopping 10 points this year. Some might say it's time for some mean reversion, meaning watch out to the downside. But not my next guest. Katie Stockton is Fairlead Strategies founder and a CNBC contributor. It's great to see you, Katie. And you think this breakout, this keeps going up and to the right?
Well, the breakout acts as a positive short-term catalyst, and we do have long-term uptrends still in place for the large cap indices, for the small cap indices like the Russell 2000 index. So we're trying to honor those, especially when we do have positive short-term catalysts like this. The breakout for the Russell 2000 index and its IWM ETF is really compelling in part because we haven't seen outperformance recently by those small caps. So they actually had underperformed the large cap proxies like the S&P 500, and therein they look relatively oversold. And so that could be opportunity not just in absolute terms, but also in relative terms. So we're seeing that pullback in the ratio between IWM and SPY is somewhat compelling, and especially because it occurs within the context of what appears to be a long-term turnaround in favor of IWM. It's kind of unusual because we tend to see small caps do better in weaker equity market environments, but this time might be different.
Well, or it's going to be weaker because Julian Emanuel, no, was it him? Was Krinsky was ranting about how this is usually a bad time of year. Anyway, we'll talk about that tomorrow. What about what's going on with the memory trade? SanDisk down 60% peak to trough this summer, and then it's up 77% from the lows. What do you make of this kind of activity?
Well, it's back off to the races, it seems, right after such a severe correction. When sentiment shifts in this world, it can shift really abruptly. So we've seen short-term momentum improve for the likes of SanDisk and Micron. In fact, we were writing them up this morning, and I think as we were writing our article, maybe 5% later, yeah. it's still relevant, though. I mean, the momentum shift is meaningful. And we did see leadership from these stocks ahead of the corrective phase in June and July. So right now we are looking for more short-term upside leadership. But unfortunately, some damage has been done with the corrective phase to their long-term charts. So we're at risk of seeing the monthly indicators, things like our stochastics, rolling over at the end of this month. And that could be something that forebodes for a more volatile, just choppy environment.
All right, I want to ask you about Bitcoin because that's an area where you see, again, some upside, and it just kind of feels like it goes nowhere.
Lately, it has felt that way. It's not always like that. It does tend to enter prolonged consolidation phases, but then the advance or the decline can be pretty sharp and dramatic. So we're just watching the key boundaries of the consolidation. And longer term, we do have an oversold reading to enhance what we now have as an oversold upturn on both the weekly and daily charts. So short-term signs of downside exhaustion within a long-term oversold framework. And really, Bitcoin is not that far from key long-term support, which ranges from about 58 to 60,000. So we think that this choppiness around the low 60,000s is related to that support.
I want to just squeeze in an observation, which is back when you were with us in May, you had said the software sector was more compelling as a turnaround and a newfound source of leadership, which we've seen to some extent, maybe from a surprising area, which is really more of the cyber area, although some of the other names too. Any update there?
Yeah, we have seen a meaningful shift between the ratio of software to semis. I think it's fascinating and largely driven in part by Microsoft, the likes of, say, Zscaler, ServiceNow. So there's a lot of participants now in this turnaround, and we see the reversal in that ratio as potentially the beginning of something more meaningful and lasting, meaning software is outperforming semiconductors. But in the very near term, especially with this recovery in the memory chips, I think they have their turn again.
All right. Katie, thanks. Always appreciate it. Katie Stockton. And that's it for us. Thanks for watching The Exchange. I'll join Robert Frank, who is in for Power Lunch after this quick break. Stocks are near session lows with Iran tensions and the Fed all looming in the background. Welcome to Power Lunch alongside Robert Frank. Welcome, Robert.
Great to be here.
I'm Kelly Evans. Brian is out today. And Meta is on trial. One of the world's most powerful tech companies facing a major legal test. Opening arguments begin tomorrow. What's at stake? We'll get you ready for what to expect.
And it's a huge week for retail earnings. Home Depot, Lowe's, Target, Walmart, all on deck. Are shoppers still spending? And who is winning the battle for the American wallet? Retail expert Jan Kniffen going to give us the lowdown. And then some serious toys. Brunswick CEO will show off a high-tech boat that drives itself. Plus, 2 Italian supercars making a lot of headlines.
The boat drives itself now? Okay.
That's what I hear.
And we begin with the ever-growing AI tab because the AI spending boom may be far bigger than even the headline CapEx numbers suggest. According to the Wall Street Journal, 9 major tech companies have racked up roughly $3 trillion in off-balance sheet commitments, much of that tied to data centers, chips, and infrastructure needed to power AI. That's 5 times the $600 billion or so they've officially reported in capital spending over the past year. And these future obligations, they're growing a lot faster. So is Wall Street underestimating the true cost of the AI arms race? And should investors be worried? Joining us now is Pence Capital Management CIO Dryden Pence and Fundstrat's Head of Research Tom Lee. It's great to have you both here.
Great to be here.
Dryden, kick us off. First of all, what are your thoughts on the Mag 7 type of big tech? I don't like the word hyperscalers, but are these companies that you own or have been avoiding, just so we get a sense for how these commitments might factor into your views?
Short answer is yes, we own them. And for a long time, I've been saying buy chips on dips because we think that this is just the infrastructure build out of AI. And so when we look at all these large numbers, we're recognizing we're going through a transformation for our economy that's as big as the Transcontinental Railroad. We're spending about 2.5% of our total GDP on the AI build out, maybe a little bit more. Well, that's about what we spent on the Transcontinental Railroad from 1850 to 1859.
Refresh my memory. Which were the right railroad stocks to bet on during that time?
Not all of them.
Not all of them. And that's true. Not everybody is going to knock the cover off the ball. But you have this insatiable desire for being in front of what's really important. I mean, it only matters if it increases labor productivity. If AI doesn't increase labor productivity, it's just a cute game.
But in other words, you don't care if it's $600 billion here or whatever trillion in the future. As long as they're spending on the railroad boom, you're okay owning these stocks.
We're spending on the AI boom, and we're going to spend in 2027. We're going to spend more on AI and that boom than we do on the Department of Defense.
Here's the thing that, Tom, I wonder about the Wall Street Journal article, because when I see all that off-balance sheet financing, I start to remember Enron and all the off-balance sheet financing. And it's on top of that, you've got these structures with the private credit funds that have a holding company that's in the JV, and then there's a third company that actually is issuing the bonds. So in the end, who's holding the bag? And is that more obfuscation than actual good business? And should we be worried about what seems to be a lack of transparency in terms of who's really lending the money and who's going to be stuck with it in the end?
It's a great question because I was a tech analyst during the dot-com and fiber boom of the 90s. And the people investing capital at that time were not of the same ilk and caliber of the Mag 7. You know, these were companies that were digging up railroad lines and doing those IRUs, you know, which was actually...
What's an IRU?
It was a revenue swap between fiber companies. So you could create hundreds of billions of dollars of contractual revenue. And today we have companies with really sizable moats and some of the highest profit margins and return on capital in history, and have, as the Bezos metric, have delivered trillions of dollars of shareholder return that are now directing their investment on building a new moat around AI. So I have a lot more confidence that these are high-level board, well-reasoned companies investing, but they're eye-popping numbers. But the reality
Why not do it on balance sheet?
Well, one, they could do it on balance sheet, but if they did, they would be taking up all the capital of the world and all the risk, and therefore actually make it harder for any. I would argue that that would make it harder to democratize AI.
Can I ask an accounting question? We were calling this off. I did get a C in accounting. I got a C, so I need to ask all of you to make sure I'm understanding this. they have off-balance sheet commitments because they're future commitments. Is that right? They're not hiding anything.
Yes.
They're not on the balance sheet because they don't flow through the balance sheet until the building actually begins. So in other words, this is just a different way to look at if they say, okay, we're going to spend whatever amount in 2027. Can you explain to me exactly what these commitments are and why they're not on the balance sheet and when they will be?
Yeah. Well, I think maybe a good place to start is I think that the revelations from the journal article are actually helpful, but they're giving people an incomplete picture of how financial systems work. Because if you do, the gross obligations of the financial system, it's multiple times the underlying assets.
Always or just today?
Always. In fact, that's why Warren Buffett used to call credit derivatives, the weapons of mass destruction.
Are these credit derivatives that we're talking about, though, or these are just future spend commitments?
It's the same. Arguably, it's not that different, because if you did like gross exposure of swaps or options, like look at in any day, options contracts are multiples of cash underlying. So if someone says, oh, there's a hidden off-balance sheet risk that retail investors have 20 times the size of the stock market in bets, we'd be like, well, there's the offset. So I would say when we look at these numbers, it's giving a distorted view of the actual risk.
Let me just press this analogy one more. In other words, do you think that the spending is representing multiple possibilities of spend that's only going to manifest in one way?
I think, to me, none of these contracts are going to lead to criminal liability. Like, in other words, like a company can decide to cut spending in the future, and the contract should be weak. So, like, the $3 trillion isn't like, people have to sign over their kidneys to meet.
And Dryden, how should investors think about this? I mean, should they be worried, or should they be encouraged that, wow, it's not just $600 billion, it's actually an additional, 1.4 or up to $3 trillion, and so therefore that's a good sign about the future of AI. How should investors interpret all of this?
I think it's a good sign because companies are making a lot of money, free cash flow. And what were they doing before? They were buying back their own stock. They didn't have anywhere to go with the money that they were making. And so I like it when someone's, no, I'm not going to buy back my stock because I'm going to actually put it into the thing that I do best, which is grow and do these things. So I like that the capital is being redeployed into what these companies do, because that's their core business. They're not hedge funds. They need to be out there putting their money to work in what they do. So as a growth investor, I like it. I like CFOs and I like CEOs and I like boards going like, this is our fastball. We're Microsoft.
And you talked about the productivity litmus test. A lot of this, particularly the bonds, are based on revenue expectations in 2 to 3 years that are ginormous compared to what they are today. Do you think we get there based on what you're seeing?
56% of the companies today have an AI account. But only about 30% of them 30% of them say, hey, I'm seeing increased labor productivity, and only 7% say we fully implemented. So you have all of these companies that have yet to play. You have all these companies that are just now scratching the surface. We're moving from infrastructure to implementation. We're moving from proof of concept to rapid adoption. And this is an area of time where we think, margins are good. The moats are getting wider.
You think that can happen without a dramatic rise in unemployment?
Yes.
That those productivity gains, because productivity gains come in some ways by replacing workers with AI.
Well, this is true, but you've seen this every time. I mean,
right.
People got upset. The guys who were shoeing horses got upset when the Model T came out.
Right.
But next thing you know, they got a perfectly good job working in the factory, and they were making more money when it was over with. So I think that we see this transition, but I think it's positive. It's Jevons paradox. And
so it's a J curve. You don't see the bottom of that J curve being too severe.
No, I don't. No, I don't. And we only need about 30 to 40,000 jobs a month to maintain our unemployment rate now anyway. So the break-even point is less.
Yeah.
The adoption's more. Labor productivity is greater, and that increases profit margins.
I'll end by I'll just throw another major concern on the table. I mean, why not? Tom, $40 trillion in the national debt last night. What is your reaction to or take on that?
I mean, it's pretty shocking that we're in a booming economy and the deficit's growing.
Missiles are expensive.
Yeah.
Interest is expensive.
Yeah.
Yes.
Yeah. It seems like there's a lot of outflows. I agree with the folks who think that this is a structural concern, but the bond market today is signaling that it's completely okay with it. So I think as long as it's okay with it, the stock market is fine.
So that little blip in the 30-year, we saw those like, oh, the deficit's suddenly an issue that we saw last week with that sale. You don't think that was really a big move, or that's going to continue?
Yeah, I mean, it is a symbolic rate because, as you know, maybe more companies are dependent on the spread to the 10-year.
Right.
So that's the more important rate to watch. But again, like I don't think it makes any sense to not be fiscally sound as a nation. So it is
Except it's
trouble.
hard. It's really hard to figure out.
Yeah.
You know, what's amazing is that 10-year range has been so tight for so long. And you know, everything tells you that should be higher, or you know, but it's.
Well, here's the crazy part. It was sub 4. I'm stealing Rick's lines from his mouth. We were below 4% on the 10-year right before the Iran war broke out, and oil prices right. But now the oil price is back down, and the 10-year is at 471.
Right. And you could argue oil should be higher today and everything else, but it's not.
Yeah. Dryden, a quick final thought.
Well, the short answer is oil in the 80s, we're fine. At low 80s, we're fine. The economy works fine. And then if you get down into the 70s, we get to $3 gas again. So I think that at some point this results. Look, you know, economics beats politics every time.
I don't know about that.
And sooner or later, we're going to be able to be in a situation where we'll have better economics.
Dryden, I want to believe you. I will hope to believe you. Tom, thanks so much for joining us, guys. We appreciate it. Dryden Pence and Tom Lee. All right, Goldman Sachs says the bond market is still too hawkish on the Fed. The firm now calls for a September hike very unlikely after a run of softer retail sales and weaker jobs and cooling inflation. Rick Santelli joins us now. Rick, what's your take?
Well, first of all, Robert, I'd like to welcome Goldman to my side of the equation. I've never thought we'd see a hike this year, especially not in the September meeting. But first of all, let's start out with what the CME is looking like with respect to probabilities on their website. And right now it's hovering right around 33%. So we're talking about 1 in 3 possibility of a hike at the September meeting. But Goldman, well, they're well-founded, in my opinion, on their comments today. Let's look at the last 3 job reports, shall we? Non-farm in May was positive 63,000. In June, it was 20,000. In July, it was minus 23. By my math, over 3 months, our average job creation is 20,000. Now, many would say, well, that's because between immigration and population growth, positive 20,000 isn't too bad. Well, you know what? Maybe it isn't as we readjust our baseline, but for the moment, it is a deterioration. And 3.2 year over year average hourly earnings in the last jobs report was the weakest rate in 5 years. Now, if you consider that 474 is the high yield close from the last day in July for a 10-year, Robert, you're right. It has been a compacted range. And even though it has gone from 394 on Feb 27 to where it is today, with a big jump in nominal rates, the reality is it's been slow going. And percentage-wise, the rise in yield is much more significant than what we're looking at in oil. But maybe it's the rate of change in supply-side questions in the Middle East, not so much the price of oil. We were under $70 briefly, and I understand we're not as low on the second chapter of what we're going through in the Mideast, but I think the stickiness of it and the constant barrage by Fed officials and benchmark Fed watchers that the longer this conflict goes on, the more it's going to hurt the economy and make a situation in inflation more permanent. I think that really explains what's going on. And I think also at 8:30 Eastern, when we had a strong empire, did anybody notice how rates jumped? They're becoming much more sensitive to what's going on in the economy as well.
All right, Rick, very well said. As always, we appreciate it. We're just getting started here. Lots more coming for you. How do we regulate AI and at the same time harness its benefits? Also, what do you need to know before this massive week of retail earnings?
All right, teammate, that's pretty much going to wrap it up for today.
Tessa Brewer is going to join us.
The move that I see already happened. Called it out. 775 to the 7734. Let's go ahead and wrap it up for today. Look for another opportunity if it presents itself tomorrow. Thank you all for tuning in. Good afternoon, SRC fam. I know that's right, Quiet Soul. Thank you, buddy. Yes, sir. I look forward to getting money with you guys tomorrow. God willing. Bye for now.